A warm welcome to all again for day 3 of the BCI Global Investment Conference. Very good to see most of you all back again. A lot of people still logging on. Susie Chasm is an author, a thinker, poet, writer, humanitarian, a philosopher, and more so a lover of wisdom. One of her more famous quotes is, "Doubt kills more dreams than failure ever will." How many times do we not find ourselves doubting in the investment world? Things are looking great now, so should I not move my clients more into growth assets? And a year ago, we had doubt if recovery will ever continue as we saw that it did. And at that point of time, we also thought, shouldn't my clients be more defensive? You are all world-class financial advisors, and you have a plan for each one of your clients. Stick to the plan. What may change is what managers you use to execute this plan. I trust at the BCI Global Investment Conference, we're able to provide or identify some of these top managers that may assist you in implementing these financial plans with your clients. Our moderators in the panel discussions are also some of the top DFMs in the country that, if you want and if you may, can assist in formulating and executing these plans. I must commend the BCI team for hosting such a brilliant conference year after year. You keep on raising the bar. Thanks, Robert Walton, for finding such top quality managers, or should I rather say, thank you to these top managers for finding BCI. We are nothing without our top artists, but more so, we are nothing without you, our audience, the financial planners. So thank you so much for your continued support. It's always greatly appreciated. Right, let's jump right into it. Joining us now again is Tavonga Shivize, Chief Investment Officer from Boutique Investment Partners. You've met him yesterday, here to introduce our first speakers of the day with local fixed income. Tavonga, very good to have you back on the session, and I'll hand over to you to introduce the next panel. Thank you.
Thank you so much, Eugene. Good morning, everybody. Welcome to our third day of the conference. I'm going to start off with a fixed income panel, and listening to so many of the speakers on equities and the return potential that could come out of that class. One of the things that is on my mind is how do you stay relevant as a fixed income manager? So I think to help address that, we're going to kick off with Aluwani, who is convinced you can always find a better way to deliver very strong real returns. And delivering that message is none other, I think, than one of our most experienced fixed income managers in the country, Conrad Wood. Soon after that is the first fixed income manager I was introduced to when I started my career in 2006, Arno Lawrence. I think back then he was still managing the old Mutual Enhanced Income Fund. And he says it's way, way too early, and maybe there'll never be a time to write off fixed income. So he's going to come in and talk about the importance of experience, how to manage black swan events. I think with the South African bond market offering very good real returns, but with a very high chance of the fiscal trap, he thinks that there is ways of thinking about it from a black swan moment. He also brings in a very interesting concept of anti-fragility, like literally being able to have resilience past any other form of shock. And I think if we just look back into his experience, there's no other better person to sort of deliver that message. So Arno, we're definitely looking forward to that. We also then have Visio Capital coming in with Jonathan Meyerson. And I think what he's really saying is you might have to unconstrain your thinking. You might just have to remove parameters that do not serve you very well. Does this mean that he's coming in with a Mario Draghi type of attitude of do whatever it takes? I don't know. We'll find out more from Jonathan Meyerson. We're going to finish off with Catherine from Western Asset Management. I think she probably has a much tougher role of talking about fixed income in a global context. But I think just having a quick preview of her message, it's quite interesting that there is actually a very strong place still for global fixed income from so many perspectives, both return and risk management. I don't want to get too much into what they have to say, but I think at this point in time, I'm convinced that this remains a very relevant portfolio, both on the a very relevant asset class, both on the local side and offshore side. I'm going to hand over to you, Conrad. You can take it from there.
Thanks very much. Good morning, Tavonga.
Good morning.
I'm going to just try the dreaded screen share.
Perfect, Conrad.
Great, brilliant. Good morning, everyone. Thank you very much for dialing on, and thank you to BCI for this awesome opportunity. My name's Conrad Wood. I'm head of fixed income at Alawani Capital Partners, an independent investment manager, owner managed, and we're just over 5 years old. Given that we've recently launched a new portfolio in the multi-asset income category of the unit trust sector called the BCI Flexible Income Fund, I've dedicated this presentation to just having a scratch around that multi-asset income sector, sharing a few thoughts and observations, and then perhaps giving you some insight into how we put a flexible income portfolio together in what is a very uncertain and environment. So if we just have a look at the sector in general, a few observations. I mean, we're all aware, and it's been covered over the first 2 days of the conference, how significantly the sector's grown. So the panel on the bottom left-hand side shows that at 170 billion in 2019, it's virtually doubled as fixed income assets have delivered fairly decent performance, and arguably some of the asset classes have other asset classes have perhaps lagged where investors expect them to be. And so you've had this massive money flow into the sector. The graph on the top left-hand side, though, shows a very interesting picture. And these are each of the funds in the multi-asset income sector. And yes, there are 105 of them. This reminds me of the general equity sector maybe a decade or so ago, where at one stage, there were more general equity funds than listed equities on the stock exchange. So I don't envy the need to pick one or two of these managers from your perspective. One other glaring observation from that panel on the top left is that you can see almost this David versus Goliath scenario that's developed in this sector, where the top 10 funds are responsible for managing 65% of the assets under management. And the bottom 20 funds are all smaller than 200 million. Now, if I was having to choose a fund in this space, I would be wrestling with this. On the one side, you have sustainability. Am I going to be in a fund that's going to make it? Am I going to be in a fund that's going to have longevity, that's not going to merge with another fund or not be around? And then on the other side, you have the issue of flexibility. Am I in a fund that's too big, that is too big for this market, and is unable to add flexibility and nimbleness to its process? So that was quite glaring to me when I looked at this chart. To help you with the selection process, maybe we can scratch around in the performance versus risk of these funds. Now, I always am intrigued by what appears to be an asymmetry of investor expectations in this multi-asset income category. No investors ever come to me and said, "Yo, you've done 10 or 11% this year. That's absolutely fantastic, but what's the risk in the fund? How have you got to double-digit returns? Tell me what I should be worried about." So up months go unnoticed. Down months seem to cause untold chaos. A negative month generates any number of advisor conversations and Zoom calls as to what's going on the risk side. So that's an important point to make, is that there is quite a dispersion of performance and risk in the sector. And you guys need to be very aware of the type of portfolio and its strategy that you're investing in. So if we look at the panels on the left, these are just charts, or the top left one is a scatter plot of all 105 funds in the sector and the total returns that they've delivered for the year to the end of April. And you can see a dispersion that is quite fascinating, and I've never seen one so wide, where you've got the top performers having done comfortably double digits as far as total return goes, and you've got the bottom performers barely beating zero, or barely adding any performance at all over the year, which is just incredible. And it talks to the volatility in the market, but it also talks to the different approaches in these sectors. I would not have thought one could have dispersion of as much as 10% between top and bottom managers in a multi-asset income sector. The panel below shows the distribution, and you can see while there is a clustering of managers between the sort of 7.5% to 9% total returns for the year, you can see how the tail goes out on the upside and the downside in terms of managers that have outperformed or lagged over this time. So what is the risk profile? What are in these funds? What causes this volatility? What causes this dispersion between managers? And as I've said, we tend to focus on the downside of returns in these funds, and investors always seem to get surprised when these funds lose any money. So the top panel on the right shows you the single month return in March 2020 when the COVID pandemic broke. And admittedly, that was a very unusual event risk. And 85% of the funds delivered negative returns in that month of March 2020. Perhaps forgivable, just how uncertain and how impactful that month was. But if we look at March 2021, which I would argue are more sort of normal market conditions, yes, you had a move up in US Treasuries that shook the boat a little bit in fixed income, but a fairly normal month in terms of what one would expect in fixed income markets. And there, over a third or close to a third of the portfolios in the sector delivered negative returns. So my message here is there is upside performance in the sector, but the way that it is generated, guys, means that there is risk that is taken, and one needs to be aware of the risk. One needs to be aware of where you want to sit on that upside return versus downside or risk perspective, and that's very important when choosing a manager. So how do we go about constructing these portfolios? Well, in the panel on the left are the key things that we think are important for you to think about when you're a manager, and for you as an investor to ask your manager. So return versus risk. I've touched on this already. What are you trying to deliver on the upside, but what are you doing to protect the downside and avoid drawdowns and avoid underperforming things like inflation and cash? Very importantly, how much are you looking to make from capital gains versus income in these portfolios? Capital gains is where you make additional profits over and above the yields that you're earning as these fixed income asset classes rally. And by virtue of that, you can have capital losses as well if they do sell off. So how much as a portion of the return or the outperformance of the benchmark comes from capital? How much comes from income? What is liquidity risk? We've just experienced the COVID period where funds in this very sector were unable to pay investors back in terms of withdrawals during the crisis, admittedly in a fairly unique time in the market, but liquidity, how am I going to pay investors back if they come for their money? What type of withdrawal can the fund tolerate without impacting the other remaining unit holders? And then benchmark, what are you trying to do? What are you trying to beat? Are you trying to beat cash? Are you trying to beat inflation and provide real returns? Are you trying to beat some combination of bonds and cash? Manager, very important to know what your benchmark is and to target it and to position the fund accordingly. So if you'll forgive me for a sports analogy, but I find that that's the easiest way to think about how we construct portfolios in this space. And on the strategy board on the right-hand side there, we divide our investable universe, or what we can invest in portfolios, into 4 different positions in the team, if I can put it like that. And first and foremost, we have what we call attackers. These are the views in the fund, or the asset classes, or the particular types of instruments or sectors we invest in that are going to lead the charge. These are the investments that we look to generate capital gains over and above the income or the yield that the portfolio is earning. At the same time, we acknowledge the uncertainty in the market, the volatility in the market, and the fact that we just simply aren't always right. We simply are not always good at choosing the right attackers and allocating the right proportion of the fund to the attackers. So you've got to have defenders. You've got to have those positions in the fund or those views in the fund that are there to mitigate losses, that are there to hedge losses, that are there to protect the portfolio when things turn against you, and they will. And then in the middle of the board, we have 2 very important components of the portfolio, which are really the bread and butter, the stability, the core, the spine of the team, if I can put it like that. And we call those the dependables, which are those that we can really rely on, your go-to members of the team. They just generate yield and income, and they plod along in a consistent and stable fashion. Very important to have in a diversified income portfolio. And then something we think that is quite exciting and new and maybe sets us apart a little bit is what we call independence. Things in the portfolio that are sort of unexpected, that are uncorrelated with the rest of the things in the portfolio, that bring a fresh perspective, that bring some new dynamics to the fund, that actually increase or look to increase return, but reduce risk in the portfolio. And this is a very important area for moving away from the so-called South African Inc. exposure that is sometimes prevalent in these types of portfolios. So having given you some insight then into how we put a portfolio together, I'm going to just spend the last bit of this presentation giving you a single idea or two in each of these blocks that we think are best suited for the current fixed income environment that we find ourselves in. So if we look to the attackers, what's in the portfolio that is driving what is quite significant outperformance of both cash and inflation at the moment, and outperformance of the normal running yield that you would expect in one of these income funds. And we have two ideas in this space, and you can see them listed in the top left there. The first one is a long position or a significant exposure to ultra long dated nominal bonds. If you look at the first panel on the top right-hand side, that is the 30-year yield divided by the current money market yield. So it's the ratio of the two yields. And you can see historically that ratio moved, sometimes as low as one for one. Bond yields and cash yields were the same. It climbed to sort of 1.5%, almost to 2% post the global financial crisis. And it's absolutely ballooned to around about 3% post the COVID crisis, as long end bond yields have moved up quite sharply. And I'm not going to exhaust time talking about the risks of this positioning. We can chat about it in the chat room a little bit. Suffice to say, at this level of yield relative to money market yields, we think there's enough in it to have quite a meaningful exposure in the portfolio, and it's leading our attackers. The second attacker that we have in the portfolio is a listed property exposure, what we term the new economy listed property exposure. Now, there's a raging debate in most offices and within our team as well, whether old listed property, in inverted commas, is appropriate for inclusion in an income portfolio, just given its volatility and its uncertainty at the moment. We are finding opportunities in more specialized areas within the listed property space. And our pick here is a company called Equitas. It's a company that has operations in both South Africa and in the UK. And it's not, surprisingly, it's in the logistics business. It's in the new economy, transporting things, storing things, warehousing things, on its way to getting those things to the end user or the end consumer, who is largely online today. And the bottom right-hand panel shows you how Equitas has outperformed the broad-based listed property sector over the last year and a half. So those are our attackers. We have other attackers in the portfolio. These are our predominant two that I wanted to share with you today. Moving to defenders and just looking at how we would defend the portfolio. And there's one sort of go-to area here where you want to hedge local South African fixed income assets, and you want to hedge South African Inc. You want to hedge against things going poorly in the local fixed income market. So you generally tend to turn towards foreign currency exposure as a defense mechanism in the portfolio. Now, if we deal with the Rand on the right-hand side, yes, the Rand is in what we think is a little bit of a cyclical rally. It's been an incredibly strong rally and much needed, I think, for the economy and for the country. But the jury must definitely be out on its sustainability, especially if this bounce in global economies and commodity prices proves to be cyclical and transitory, as opposed to sort of structural and more sustainable. Once we return, and we do think that we are going to return to our old low growth environment, vulnerability as a result of over-indebtedness. The top chart shows in the red line the current fiscal year's budget deficit. It's 500 billion, or close to 14% of GDP, and it's completely outsized relative to anything we've ever had in the past. The bottom chart shows you foreign bond flows, which fund that deficit largely, or a large portion of it anyway, close to a third of it. And you can see that over the last couple of years, and in 2021, the red line, that we've seen quite incessant sort of foreign selling of our bonds. So massive debt burden, an economy that reverts to very low growth with lots of imbalances, and we struggle to attract foreign capital, makes the rand vulnerable. And at some stage, we don't have defenders in the portfolio at the moment, but at some stage, we're going to have a look at it. And we actually, favor euro or sterling rather than the more traditional US dollar, and particularly sterling. We think there's some catch up to come from those economies. The US is way out front in terms of leading this recovery, but we think the other economies are going to catch up as their economies come out of lockdown and as their vaccine rollouts catch up. And we think those central banks, particularly in the UK, will follow the Fed in terms of withdrawing liquidity and tightening policy. And so we think, introducing euro or sterling to the portfolio as a defender will be a likely outcome in the next few quarters. If we move up to the dependables very quickly, and so as I said, this is the steady Eddie part of the portfolio. And in this part, it's largely credit. It's largely lending money to a variety of institutions and getting yield or income in return for doing that. So there are many exposures that make up the credit exposure in the portfolio, many dependables that are just ticking away in the background. Our one of choice, and one that is, arguably a little bit controversial, and some of you may be carrying some emotional scars from African Bank, but I'm going to bring up African Bank as our dependable of choice this morning. This is a business that has revived itself. It's diversified itself. It's not the same business as it was. It has significant shareholders of reference still in the big banks and the Reserve Bank, and they look set to stay there in support with liquidity and capital for quite some time to come. And this bank now has the added advantage over the other banks that it doesn't have the big legacy IT systems over many, many years that hold banks back. It's had the luxury of putting together a new, modern, consumer-friendly IT system that is really making inroads into attracting new customers. They are now offering multi-bank services, so they're taking deposits, they're offering bank products, and we really like African Bank as one of the dependables in the portfolio. The chart on the right shows the real yield on 3.5-year African Bank debt. So this is the African Bank inflation-linked bond, and that is a real yield that you see there. So 7% real. You need to add inflation back to that to get your nominal real. And even if we conservatively say inflation is 3%, that's a 10% nominal yield for 3-year African Bank senior debt in a market where cash rates are at 4%. And we think that's incredibly good value from on a risk-adjusted basis. And that's our leading dependable in the portfolio. And then lastly, just to introduce you to this portion of the portfolio called the independents. And so this is going to be something outside of the box, outside of the normal investable universe for multi-asset income funds, because that's how you get the benefit of diversification, correlation, and some exposure that is going to perform independently of the rest of the things in the portfolio. And this is not a case of just aiming a dart at the world and pegging something and then choosing an exposure in that area. We have a competency in Africa, in the continent, and we analyze many of the African sovereign debt markets on macro and micro basis. And our pick in this space is the sovereign bond exposure to Egypt. The chart on the right-hand side shows you the spread in basis points that you earn above US swaps. So that's close to 350 basis points or 3.5%. We bring that back into rands, and we do pay up a little bit to do that in terms of hedging costs, but you can still bring short-dated sovereign exposure to the Egyptian government, who is a substantial issuer in the Eurobond market and is a real structural turnaround story or reform story, taking the best from both Asia, the Middle East, Europe, and Africa, given its geographical positioning. And we like to have this exposure in the fund in terms of an independent exposure, which adds some nice diversification to the fund. So just to end off,
Conrad,
In a world where, yes.
if you can be dependable and wrap up in 15 minutes here over time.
Okay, these funds remain appealing in a low nominal yield world. Understand your manager's philosophy and how they think about risk and return. There will be volatility in this space, short-term bumps. Pick a manager with robust portfolio construction, and I hope that I've shown you, or given you some insight into how we do that today. So that's me done. Apologies for running slightly over, and I'm very happy to take some questions in the chat room later on.
Good morning, everybody. Thanks, Conrad. I think you've given us a very good oversight as to the way that you're thinking about things. And certainly we know you've been through a lot of cycles, as I have been as well. So looking forward to doing dual with you in the future. Right, so what I'm going to be talking to you today about is a rather different take on the way that we're looking at markets. And perhaps you're quite intrigued as to what we're actually sort of trying to get to here by positioning Tiger Woods and Usain Bolt versus a Nasim Talib. And the question would be, if you could, in some hypothetical world, pitch them against each other, who would actually win? And maybe there's some investment lessons to be learned out of that. So,
oh no, sorry to interrupt you. We're just seeing your presenter view. So if you want to, you can go to display settings at the top of that black window there.
Right.
Top left, towards the top left, display settings.
Sorry, this bar is in the way at the moment here.
Next to show taskbar, up at the top, display settings, and then just swap presenter view and slideshow. There we go, perfect.
Okay, sorry about that. So if we jump in into this lineup, if you want to put it like that, in a sense, Team Bolt and Woods, we know that what you're getting out of Usain Bolt is the greatest sprinter of all time. So he's the speed element. And then you've got Tiger Woods, who's arguably perhaps one of the greatest golfers of all time, although I'm sure Phil Mickelson maybe thinks slightly differently at the moment. And of course, golf is, of course, being sort of representing the accuracy. And against, of course, Nasim Talib. And he's got a whole sort of background history there. Probably one of the most preeminent sort of market commentators or analysts, if I can put it like that. Certainly quite formative for myself in my career in terms of that very first book that he produced, Fueled by Randomness. And then, of course, his book, The Black Swan, as we all sort of, everyone talks about it these days, you know, and has been one of the most influential books, perhaps published in the investment space. Right, so let me just get it to go on. So how does this relate to who Sasfin is? And so certainly, if one pitches, you know, the investment excellence and risk management, that is ultimately what we're looking at here, which is speed and accuracy, giving you the investment performance, and then your intellectual rigor, which delivers for you that questioning about, and Conrad was right about it, is looking at the risk side of things. So it's that combination of investment excellence, risk management, which I hope in terms of Sasfin as a boutique with a brand behind it, has been able to do this. And certainly that is what we continue to focus on going forward as well. So let's jump into this lineup here. And first round would be testing experience. We know that experience counts. And certainly I'm going to do the easy one here because perhaps I'm tending towards the Nasim Talib side of things. And so certainly it's time in the market in a sense. That's going to be an easy gimme on this one. So I'm going to so easily say Nasim Talib wins this one hands down in the sense of he's just older and he's got more experience. So you can have the David and Goliaths, but in this case, Nasim is going to win. So we'll give it to him on that one. The round two, let's measure up the Black Swan effect. You know, these are issues that, as we know, if you think about the Black Swan effect, you know, it is the arrival of an unpredicted, low probability and high impact event. And certainly we seem to think in our lifetimes and in our careers, we've had way too many Black Swan events. And so certainly if everyone thinks about the 2008 crisis, we can think about COVID, we can think about going back further into the emerging markets crisis in late 1997, there or thereabouts. And so certainly from that perspective, thinking about the black swan effect is an important component of what we have to have as the investment managers and our approach to dealing with them. The whole point here is that it is traditionally, we could say, or as it's defined, is an unpredictable event. So it's not something that you can prepare for in the same way as COVID was not something you could prepare for beforehand. But the point would be is that in terms of your risk management approach, is being able to deal with that. So for example, Conrad touched on liquidity. If you're not able to have the liquidity to deal with these sorts of events, how are you going to get through? So in this particular case, we can think about Tiger Woods, and certainly when he won, the major in 1997 at age 21 by 12 strokes, which is still the highest winning margin, as well as being the youngest winner ever. That is, from a professional golfer's perspective, that is a black swan event. I pity poor Ernie Els at the time, who probably was heading towards the top, and along came Tiger Woods and destroyed essentially his possibility in the career. But in terms of one year, I give it to Talib, because ultimately he was the one who popularized this whole issue and the element of a black swan event. So again, I'm going to give it to him, and we'll probably say, sorry, I said it's a tie on this one instance, because you've got a quintessential black swan and the guy who popularized it. So I'll put it as a tie on that basis. Another element of markets, timing. And we know, if you've been listening to the speakers through this conference already, one of the issues that comes out is trying to time markets. We know is an incredibly difficult thing to do. And so certainly from that perspective, the issue that we have to deal with here is, how would you be able to react? Again, if it is, for example, even a black swan event that arrives, a COVID or a global financial crisis, how quickly can you react based on a whole bunch of things within your career and within your team and the skills and capabilities that you have? Is how quickly can you react? And so just an interesting statistic here is that if one goes back into the Rio Olympics, the 100-meter final, and you can see here that the reaction time to the starting gun of Usain Bolt was second slowest, and yet he still came out the winner. We did have a representative there, Akani Simbine, who was the quickest out of the blocks, but unfortunately was not able to deliver it all the way through. And so certainly from that perspective, I'm going to have to say here that, Talib was a little bit slow to realize that perhaps timing markets was not great in terms of skills. So he realized that he's got to get out, and then became an author, which obviously very successfully so. So I'm going to give this one to Bolt in this case. Right, and then if we move up into the next one, which is again, and again, Conrad, I have to commend you in terms of highlighting all of these things, is the risk side of things. So it's taking hidden risks. And so if we think about portfolios, and again, this is the issue here, is that when funds, managers underperform, generally speaking, and this is not just a fixed income story, but across the range, it's mostly going to be because of some form of undisclosed or hidden risk that is not disclosed in the sense of that people want to see. So traditionally, when funds are presented, they tend to show return. Here's the volatility of the fund, i.e. risk, and you can see how we positioned. But what is not shown is, for example, what is the duration risk that's been taken? What is the credit risk that's been taken? Is there any basis risk that's been taken, et cetera, et cetera? So certainly, and in the equity space, of course, we can talk about things like governance risk in investing in companies who perhaps, if I think about a Steinhoff and so forth, those are the sorts of examples. So who's the winner here? I'd have to give it to Woods, purely because he was taking some hidden risks, and it's a combination of his experience in a few things, the black swan event of his wife finding out about it, and then, of course, his very quick reaction time to escape, down to the bottom of his driveway in this particular instance. So certainly there, we're going to give this one to Team Bolt Woods. Okay, so let's go for the final round in terms of elements of looking at funds and the markets. And this is about aiming for anti-fragility within portfolios. So just to touch on what this is it's beyond a resilience or robustness. So if you think about 2020 and we think about COVID, is what happened afterwards in the equity market was we had that immediate knock to the market. And then we had a number of companies that performed out of this world. And the market was looking for those companies that had resilient business models. So, for example, the likes of an Amazon and so forth, and we can think about Microsoft, Zoom, et cetera, that out of this crash, not just was able to stay the same and survive and be resilient. In fact, they even got better through this. So that's the concept. So let's have a look at the evidence here in terms of our lineup. So Usain Bolt, as we know, greatest sprinter of all time, but in his final race in 2017, it was, yes, admittedly a relay. He pulled a hamstring, unable to finish the race. And then, of course, his team, of course, wasn't even able to finish either. He did also set a world record in 2009, which still stands. But despite training for another 8 years, he was unable to bet at the time. So from an anti-fragility perspective of getting better, I'm going to say that he's resilient, but he's not anti-fragile. Okay, so let's have a look at Tiger Woods as a second try at this one for the team. So if you look at Tiger Woods' injury history, for those of you that follow golf, you'll know that he's never far away from another one. And so certainly his injury list is perhaps what kept the medical profession busy throughout his career. He also has a history of crashing cars, most recently, of course, earlier this year, which I started to suspect was some attempt to prove his anti-fragility because he knew what was coming at the BCI conference. But I think it's a vain attempt and certainly in my mind, very fragile. Okay, so Nasim Talib is going to have to deliver here. So if I look at his career, where he started from in terms of being an options trader and moving on to becoming an author, he was never fooled by randomness. He predicted black swan events. He wrote the book on anti-fragility, and he also has skin in the game. So in my mind, he is going to be the winner on this one, which leaves us, of course, with an overall tie. So what does that teach us in a sense? And the lesson learned there really is that you ultimately need to have performance and risk management. It's not good enough to only focus on the performance side of things. You need to balance it out with your risk management side of things. So in terms of these lessons, so experience, or as I termed it, time in the market, counts a lot towards making decisions that are resilient and robust in a portfolio management context. Be prepared for black swan event risk in the sense of having a strategy to deal with it. Timing is important, but it's not everything. So having other skills, i.e. diversifying. In the case of, if I use that reaction time of Usain Bolt, perhaps if he was able to improve his skill in terms of reaction time, who knows, maybe he would have beaten his own world record. And then, of course, be careful of hidden risks. And certainly this is the point is that our approach to investing is certainly one of taking risks which are disclosed and transparent. And then, of course, is aimed to include investments that do well when things go wrong, which is that concept of anti-fragility. And so then in the context of South Africa and in what we're trying to do in our fund and across our range of funds is a combination of performance and risk management. So if I run through where we are, and again, my learned colleagues from yesterday as well as today in this fixed income space have highlighted some of these issues around and the value status of South African long-dated government bonds. South Africa remains in a fragile state, and so assets are cheap for a reason. So we are certainly not of the opinion that we're about to enter into a new bull market imminently. So certainly there are opportunities, but in much the same way as we look at equities and say certain companies are extremely cheap, but they are a value trap, is the possibility remains that South African bonds could also be a value trap. And so certainly we don't want to put all of our eggs into one basket and saying this is an approach, an opportunity that is a no-brainer. So certainly a very well thought out approach needs to be implemented. And of course, this speaks to having a diversified risk approach without taking on inappropriate, or as I termed it earlier, inappropriate risks. And so certainly within that context, we try to balance our investments within, for example, say, long-dated bonds as well. And then the other bit is including assets to protect against black swan or these tail risk type events. And one example of that would be, for example, in looking at inflation linkers. So if the fear is that South Africa becomes fiscally unsustainable and there's this fiscal slippage and hence South African bond yields are going to go even higher, well, you know, if there is that realization, certainly what we would expect is that it would be a combination then of perhaps that we're not entering into a commodity super cycle that comes to our rescue, and that this fragility that we see in South Africa, not just in our fiscal side of things, but across the state. And so certainly from that perspective, we could easily then see, a rand blowout type scenario. How would one protect against that? Well, not just by taking your money offshore. If that were the case, you'd have higher than expected inflation. And so certainly then inflation-linked bonds would present a great opportunity. They know that the real yields in those inflation linkers are, for example, close to 4%. Not as high as what you're getting in nominal yield bonds, but certainly they provide a hedge against these sorts of events. So I hope that I've been able to provide you with some sense of the way that we think about things. And certainly I hope that it's been clear to you what I'm trying to get across here. And of course, I apologize to Tiger Woods, Usain Bolt and Nasim Talib for using them in this way and pitching them together. But I hope it's highlighted the fact that investment performance with risk management is what you're getting out of SASFIN, and hopefully, you can get some sense of the way that we approach the management of our funds. So with that, I hand over to Jonathan. Thank you very much.
Thank you, Arno. It's a great introduction and way to come into my presentation, which I'll share the screen now. And I'm hoping that you can see it.
Yeah, perfect, Jonathan.
Right. So the topic of the title of the presentation is South African bonds as an inflation hedge. And, conventionally, bonds are certainly not considered to be an inflation hedge. So when you looked at the title, you probably scratched your head and thought, what's Jonathan on about here? So in the presentation, we'll already be distinguishing between different types of bonds and how useful they are in protecting inflation and investors, basically real assets. If we really, I suppose the question is, why are we even talking about inflation? So for the best part of the last 12 years, really, until probably the end of last year, we've been more concerned, at least globally, about deflation than inflation. If you look at longer history overall, inflation trended up since the late 1920s to the end of the 1970s, with significant spikes around the Second World War and the oil shock in 1970 around the Yom Kippur War in the Middle East. After that, inflation was really on a declining trend. Most of us actually, maybe Arno, Conrad and myself, caught the tail end of the high inflation period in our career in the market. But really, most of the time what we've been dealing with is actually inflation declining. And also, too, even in the downward trend, we had spikes like in the early 1990s during the Iraq War, the late 1990s during the dot-com period, mid-2000s, the commodity boom, and then the post-GFC inflation spike in 2008, 9, and 10. So really, if you look at these episodes, inflation has spiked either post a crisis or during a commodity boom. And possibly what we see now is a little bit of both. And I think that's what kind of highlighted or is brought the inflation concerns into focus. If we look at the most kind of the specifics of what is worrying us from an inflation perspective, is that there's a global buildup on inflation as seen in some of the leading indicators. So if you look at the US inflation break even, it's back to levels that we saw in 2008, post the GFC. Public interest in inflation is very interesting. This is the number of searches on the word inflation in the US, this is in particular in the US, on Google. So clearly, the man in the street is more concerned about inflation than they've been for quite a long time. And this is the weekly hits as a percentage of previous hits. So you can see a real spike more recently. Commodity prices also kind of pretty close to what we had in the post the GFC. In emerging markets, this is the surprise index from Citibank. You can see, as in the case of South Africa in the last inflation release, we were surprised by the extent that it spiked. China's seeing an inflation increase, and maybe the most important and the indicator that receives the most attention lately, and is really very different to what we've seen probably since the Second World War, is the spike in US maize supply. And that's kind of really summarizes, if you like, the new policy that we're experiencing, where both monetary and fiscal policy are extremely aggressive to generate economic growth and bring us out from the kind of COVID crisis. In South Africa, it's not, the pressures are not as much. So, if you look at the same type of leading indicators, break-even inflation is higher, but certainly significantly lower than it's been over the last 10 years. If we look at the inflation Google Trends, South Africans don't appear to be searching for the word inflation. Maybe we've got other things to worry about, but clearly nothing is happening there. So inflation is not really top of mind. Food inflation is obviously quite a bit higher, and making 15% of the basket, it's quite relevant. And it's probably more to do with the global environment again than domestic, either food. South Africa's food production has actually been quite good. So in a way, we could have expected more of a spike in food inflation if it wasn't for the decent local conditions. Transport clearly a highlight, kind of concern because of the spike. And again, you need to remember that what we're looking at is a year-on-year increase in fuel prices and transport, and we're coming from a very low base effect. So that needs to be kept in mind. Very different to the US and other developed and some emerging market is the increase, or in our case, the very low increase in housing and utilities, particularly rental and house prices, making 25% of the basket. So what we've got here is that we've got a big component that is dampening the cyclical spikes from transport and food. And in a way, it's coming at a good time because it's, globally, you've got both housing prices rising, and it's all happening at the same time. We've got a bit of a dampener here. And if you look, maybe again, the biggest differentiator is the money supply and credit center in South Africa is actually really pretty weak and nowhere near what's happening globally. And really what it comes down to is that a strong boost in growth brings with it inflation. And the comparisons, again, when we use the US economic growth kind of chart, it's not dissimilar for the global aggregates. And you can see that, 2020, obviously economic slowdown, and then a massive spike to close to 6%. And then we expected, our MFP is expected to come down to more normal levels later on. But the size of the stimulus package in the US has been massive. South Africa's recovery, we probably now can expect growth this year more like 4%, maybe a bit higher than that. But given that it's coming from a contraction of 6.9%, that is not as kind of impressive, if you like, as it is globally. So where globally you find both demand and supply pressures on inflation, domestically it's more on the supply side with very, very little demand side kind of pressure, because ultimately our kind of correction is still leaving us with an economy that's significantly smaller than it was prior to the crisis. So really what our kind of base case is that the current inflation uptick, and I think certainly listening to the other speakers in the conference, is probably temporary, because many of these structural disinflationary forces that we experienced in the 2000s, 2010s are still in place. Obviously some structural changes will take place as a result of COVID, but ultimately I think the big drivers are still in place. So, but why if we're not that worried about it longer term, why we're talking about it, it's because this type of risk of inflation is, while it's relatively low probability, it's got a very high impact. it will destroy wealth and well-being if we surprised and we end up with inflation consistently higher than what prices in the assets are providing. So if we look at South Africa and we look at the kind of history of inflation, what you'll see is that the history shows that 70s, 80s, and 90s will be very familiar with this. Inflation spiked, and since the early 2000s, the Reserve Bank has been very focused on bringing down inflation. During periods of high inflation, nominal bonds don't do well at all for obvious reasons, and I'll mention a little bit, I'll broaden that a little bit just now. The same applies to money market, where your real income gets eroded. But not all bonds are made equal, and this is to the point that both Conrad and Arno made. When it comes to inflation, the three kind of broad type of assets that we talk about, so the fixed rate, fixed coupon bond, you lend your 100 Rand, you get a coupon, which let's say it's 8%, and you get 4 Rand every 6 months for that. That 4 Rand is fixed, that's it, for the life of the bond. When inflation is high, then the real value that declines. JIBAR-linked coupon, which is essentially linked to the Reserve Bank's repo rate, is therefore a function. So your real return will be a function of the real policy rates of the Reserve Bank. Currently, as you would know, actually negative. And then your pure inflation hedge, which is the inflation in bonds, where your coupon is a percentage of your capital that you've lent, and the capital grows in line with inflation. So that coupon, like Arno said, 4% is 4%. That's if you hold the bond for its life, that's what you'll get. So it's very important to essentially have these type of assets in your portfolio and have the diversification and the ability to move from one type of income generating asset to another to ensure that you don't get stuck in an inflation trap. And for that, you need flexibility, you need to be unconstrained, and you need liquidity, which is extremely important, because it's all very well to say that you need to change position, but if you're very exposed to a large amount of non-liquid, and in South Africa's case, often it would be credit, then you could be stuck in a bind. So flexibility is key, and kind of elaborating a little bit on value. And this is the yield curve, South African yield curve, all the way to 2000 and to 30-year bond. If you then adjust it for a expected inflation of 4.5%, which is the inflation target for the Reserve, you will get real yields or nominal yields adjusted for inflation, which are your real yields, of up to 6% in the long end of the yield curve. If inflation ends, you're wrong, inflation ends up being at 6% at the end of the inflation target range, then you'll get all the way up to 4% in the long end of the curve. And of course, shorter dated, because the yield curve is upward sloping, then you'll start getting negative real returns. And then the pure inflation hedge would be your inflation in bonds, which will do better than nominal bonds in the long end of the curve, only if inflation ends up being higher than 6%. And then there's the traditional floating rate, which is usually credit, which essentially will give you a lower real rate over time, particularly if the Reserve Bank has managed to somehow control the inflation and keep real rates relatively low. So just looking at it very broadly, you can see that there's quite a lot of value in nominal bonds in the long end of the curve, quite a lot of value in the inflation-linked bonds in the kind of shorter date, and some value in floating rate notes shorter. Actually, if you take this to naught, again, as I said, you get negative returns on on JIBAR instruments. So how does it work in practice? And this shows you the kind of change in the asset allocation over time within the interest-bearing instruments. And really where we're sitting now is where you get a current, the fixed rate bonds are 42% of the fund, which is a bit lower than the average, but if you look at details, it's exposed to the longer end of the yield curve where we saw that value. And to the, I don't disagree by any means that there are risks attached to that, but those essentially, that's what we measure, and we say, well, at this point, it's probably worth taking some of those risks Maybe not as much as previously, but certainly there's something there. Floating rate notes, we hold more than what we do have on average, but most of that is in banks. That allows us that liquidity and flexibility. Inflation-linked bonds at 18%, higher than what we have on average, but lower than what we had in previous episodes where we thought it was the best asset available essentially for us to invest in. So really what I'd like to kind of demonstrate is that approach of flexibility and being unconstrained is very important, and you need that liquidity. So you can see that the fund over its 5-year history has done reasonably well in providing that, beating the benchmark and really the objectives of the fund. So I think to add to both Conrad and Honor's points around what you need to look at when you choose a fund, I think maybe the one thing that has been left out and is extremely important is the objective of the fund and matching it with the objective of your investment in the fund. So if you're looking for a fund that is going to take care of your interest-bearing exposure in your pension fund, then an unconstrained type of funds that's representing here is your kind of ultimate solution. I think I'll pretty much done it with my time. We can discuss more details later when required.
Thank you so much, Jonathan. Many thanks to Arno as well as to Conrad. We will have to carry on all questions to the breakaway session as we are behind schedule. So at this point in time, I'll introduce the next speaker, which is Catherine from Western Asset Management. Thank you.
Right, many thanks for that, Conrad, Arno, and Jonathan. I know it's always challenging, such a huge amount of information to pack it into 15 minutes. But I want to ask all the presenters, if you can, let's keep it nice and tight to allow for everybody for their time slots. Right, joining us now all the way from London is Catherine Matthews from Western Asset Management, looking at why fixed income matters and the role of bonds in a world with very low yields. For those of our audience may not be that familiar with Western Asset Management, they are global integrated fixed income managers who are dedicated to global active fixed income management. Catherine, I hope I got that right. I believe Dan will put up your slides, and you can just prompt Dan to go to the next slide as we progress. There'll be no Q&A after Catherine's session, but note that Catherine will join the fixed income breakaway room with Alawani, Sasfin, and Vigio. So if you have questions for Catherine, be sure to join that breakaway room. Catherine, thank you so much for joining us. You joined us very early this morning for all the sound checks. Your time differences, very much. Thank you for that, and good to have you with us. The floor is yours. Thanks.
Thank you very much. And yes, that was absolutely a perfect introduction to Western Asset. And just as I begin, I'd like to say good morning to everybody joining us today, but also to thank our partners, Alwani, who've invited us to do this presentation to everyone this morning. So although the title of my session is Why Fixed Income Matters, the role of bonds in a very in a world of very low yields, excuse me, I thought I'd actually start with a very brief digression actually into the world of movies. So perhaps we could move to the first slide. And if you're a fan perhaps of the famous 007 James Bond films, you'll be patiently waiting for the release of the next film, No Time to Die, which has been rescheduled time and time again and is now coming out in South Africa in November. But you'll also realize that after 25 movies in almost 50 years, with the number of times that James Bond has been shot at, the probability of him actually still being alive and in retirement in Jamaica is actually close to zero. So despite the odds being stacked very heavily against Bond and rumors of his demise, they're greatly exaggerated. And there are remarkable similarities, though, between James Bond, which is why I bring it into my discussion today, and the bond markets, because developed market bond yields are at close to their historic lows. And for some time now, really, the odds of bonds have been stacked against them. And investors are worried that bonds globally have lost their diversifying properties. But today I'd like to challenge that perception strongly. Our belief is that fixed income does continue to provide, in particular, very effective diversification and play a very important role in an investor's traditional asset allocation framework. So the key takeaways from our session today, our developed market fixed income is the only asset class that demonstrates low to negative correlation to risk assets. Fixed income provides highly efficient returns per unit of volatility. And despite these low yields, bonds do maintain return potential, especially in an unexpected shock or a period of market uncertainty. And finally, global bonds are an effective tool to manage drawdown risk while providing a very good source of income and high liquidity. Other defensive asset classes, gold, for example, don't offer any income, and alternative asset classes such as real estate or private credit may have long-term return potential, but they do come with difficulties related to estimating valuations and liquidity. So with a quote at the top of the slide from our CIO, Ken Leach, I could potentially now continue with that with the movie theme for a bit longer and seek to uncover the truth of the Da Vinci Code, but perhaps instead we'll pursue now the benefits of negatively correlated assets in our portfolio construction. So if we move to the next slide, at the top, there's a famous quote from the very successful American financier and investor Warren Buffett. Investing is simple, but it's not easy. And the reason investing is not easy is that valuations change over time. So there's a wealth of academic evidence that shows that over the longer term, equities are indeed the most likely asset of all asset classes to provide high returns. But they are the most volatile asset class and the least predictable in the short term. And therefore, they could provide some nasty shocks to investors along the way if they only invested in equity markets. And for example, in the first quarter of last year, we can see on the chart here, the green line on the left-hand chart shows the return of the US S&P 500 equity index over the past 2 years. And the blue line is the return of US Treasuries. So last year, when the coronavirus pandemic spread really viciously around the world in early March, the S&P actually dropped by around 40% in a matter of days. And it ended the quarter from where it started the year down 20%. So a really violent move and sell-off in the equity markets. But on the other hand, as you can see on the chart, the flight of investors towards safe haven assets, such as US Treasuries, saw these assets rally really very sharply and almost by the same amount that equities declined. So indeed, if you look on the right-hand table, and this is using monthly data, but it really highlights that global bonds have produced positive returns in all major risk-off periods for equities since the global bond index started 25 years ago, which is really quite amazing. So it's very clear that bonds have very powerful hedging characteristics, and especially long-dated US Treasury bonds. They're even more powerful because they really are that asset of demand in a risk-off period. But they do exhibit greater volatility versus a diversified portfolio of global bonds. So that's always something to think about. On the next slide, we can see a very clear and powerful chart, I think, that illustrates how long-term interest rates are driven primarily by the direction and the level of inflation. The green line here is the yield of the 30-year US Treasury long bond over the past 50 years. And the blue line is the 3-year average of it's called core PCE. It's really the primary inflation gauge that is used by the US Federal Reserve in setting their monetary policy, the main one that they look at. And our outlook for treasuries and global fixed income is therefore determined really by our outlook for inflation. And our thoughts there is that in the second half of the year, we should see really very strong global growth as the economy reopens. But we're also cautious about extrapolating this sort of short-term cyclical boost that we're definitely going to see into a presumption of higher trend growth and persistently higher inflation. And this is really because of the secular challenges that the developed world faces of aging populations and rising debt levels, which really are now even higher post-pandemic. And these challenges have really kept global growth at a very moderate pace, at best really, over the past several decades now. So at this juncture, although headline inflation has gone up, we would gently push back on the market's view of sharply higher and persistent inflation. And the inflation rebound in the US, we think, is actually close to its peak. Supply constraints that they've been with the pandemic will begin to ease as economies reopen. Demand will switch from goods into services, and the reopening surge in demand, it will ease. So the Federal Reserve in the US has been very clear that it won't raise interest rates or tighten policy until its broad employment goals and its average inflation target really have been realized. So inflation would have to stay persistently higher at current levels for the next couple of years for the Fed to raise interest rates aggressively. So we think we can see positive growth, yet at the same time expect ongoing policy easing, and particular from the Fed and other central banks around the world. So we do think that policy stays very easy, and this allows global bond yields to actually continue to trade in relatively narrow ranges around current levels. So if we now perhaps move to slide 5, we can see on this chart that actually safe yield from highly rated government bonds is really very scarce still. And the yield, as we can see at the top of the table, from many core European government bonds actually trades at 0 or even negative. So investors are willing to pay to ensure the protection of their capital rather than seek a return on capital. So it's really quite an amazing situation, and it is driven by asset purchases by central banks and governments around the world. And many investors clearly do need to maintain a return target to meet their ongoing spending needs and to satisfy their liabilities. But with the level of yields currently, they may face significant hurdles in achieving these return targets, given this low level of government bond yields we see on the slide. So choosing the right mix of assets to maintain diversification while meeting return targets really can present challenges, with only US Treasuries currently really offering any income benefit. So as we turn to the next slide, I'm going to return again to effective risk management and the power of diversification, starting at the top with a quote from the Nobel Prize winning economist Robert Shiller. The future is always coming up with surprises, and the best way to insulate yourself from these surprises is to diversify. And the correlation of risk assets to one another is shown on the table, and it highlights really the importance of selecting diversifying assets. And over the past several years, investors have allocated some of their capital to hedge funds and private equity ETFs, but the correlation of these assets to public equities is very high at 0.8, and that's really highly correlated by any definition. And not shown in the table, actually, we were hearing earlier about South African government bonds. The correlation of South African government bonds to equities is also quite high, actually, at around 0.5 over the same period. And the only asset that demonstrates low to negative correlation to risk assets is actually fixed income, suggesting that actually fixed income is not correlated or is negatively correlated to other assets, and underscores really the importance of using fixed income as a diversifying tool. So we don't know where the world is going over the next 6 to 12 months, and we can't predict anything with precision. But we do know that effective risk management starts with appropriate diversification, and there's no better diversifying asset than fixed income. The next chart shows that fixed income does allow for efficient returns per unit of risk. So while recognizing the potential returns from global fixed income may still appear quite limited, given the yields we saw on the previous chart, investors should really still consider designating some capital to fixed income as an efficient asset allocation. And we can see here the return per unit of volatility of the various asset classes over the past 5 years. And this demonstrates in the top left-hand corner that the return to risk for global fixed income is actually the most efficient asset allocation across all of the major asset classes. On slide 8, the next slide, we think about the underlying return potential from bonds. And while fixed income yields may be the top line indicator of returns, they might not tell the full story, because in uncertain markets, this can translate into volatility, which can produce returns in asset classes and in bonds well above what a security is yielding at the time. So the chart on the left shows the yield of global bonds over the last 15 years, which at the beginning of last year probably looked really unattractive to investors, with an average yield below 1%. But in 2020, overall, global bonds returned 6%. So again, the yield is not always an indicator of the actual return over a period. And on the final slide, where are the current opportunities in fixed income markets, with investors worldwide, really looking for consistent income sources? And fixed income does continue to deliver that reliable income stream, especially in credit-related sectors. So with global growth improving, we're optimistic on credit fundamentals, technicals remain favorable, and we've very strong investor demand for income-generating assets. From a risk-reward perspective, investment-grade credit looks particularly attractive. In the US, the housing market has experienced a strong V-shaped recovery, but residential mortgage-backed bonds still remain below where they traded pre-COVID, so they look attractive. And despite recent market volatility, for us, emerging markets can benefit as oil and commodity prices recover. And at the top of the table, bank loans offer value per unit of risk. They have significant carry and yields which reset every quarter if interest rates do unexpectedly rise. So really, to conclude, back with our key takeaways, fixed income investors need to think about diversification. Bonds can be highly efficient, an important source of return, and an effective tool to manage drawdown risk. And just my bottom line, if a couple of seconds, returning to my opening 007 James Bond movie theme, we all know diamonds are forever, but perhaps bonds live to die another day. Thank you.
Catherine, thank you so much for that. Very insightful indeed, and you were spot on with your timekeeping. So really, I do applaud you. Since you're also based in London, any ties to MI6 perhaps? Right. Just a reminder to our audience, we'll take questions for Catherine afterwards in the breakaway room. So if you have any questions for her, please join the fixed income team in the fixed income room. Catherine, once again, thank you so much for joining us. Right.
Thank you. Enjoy the rest of your day.
Great stuff. Moving on, and just before we break away for tea, here to introduce our next topic on SA Multi-Asset High Equity is Adam Balkan from Sanlam Multi-Managers, one of the largest multi-managers in South Africa. SMI is dedicated to constructing portfolios that provides clients with superior investment experience and access to a range of off-the-shelf solutions and or partnering with intermediaries like yourself, where they can establish tailor-made multi-managed solutions that will suit your business. Their investment philosophy ensures that they analyze performance characteristics of all these managers that we've seen today and so much more to determine if their recent performance was just pure luck or actual skill. Right, always challenging. Adam, thank you so much for joining us, and looking forward to your panel.
Good morning, Eugene. Good morning, everyone. Thank you for the opportunity, and it's been very interesting so far. My slot is going to be on the balanced funds, the high equity balanced fund in South Africa. Obviously, a highly topical subject, one in which many investors are invested in, and it's been, as we know, a volatile and challenging environment. We'll be talking to Ford, 91, and Prudential. And for Ford, we'll be speaking to William Fraser. Dwayne Cable will be presenting 91, and Leonard Kruger will be presenting the Prudential Balanced Fund. The topics that we're going to address in this slot for William from Ford, core investing through time. Dwayne will be talking to us about why multi-asset funds remain a powerful tool for financial planning, and then Leonard will be talking to us about maintaining a healthy relationship between fundamentals of value and price. So I'm going to now turn over to William, and we await with interest what he's going to tell us. Thank you, William.
Hi there. Can you hear me, Adam?
Yes, we can hear you well, and we can see the presentation. Thanks, Will. You can go ahead.
Fantastic. Thank you for the opportunity to talk to you about our philosophy, our approach to what we think is a strategy that should really form the core of savers' long-term savings plan. And there's only really one key objective that we all need to focus on over the long term, and that is the real preservation of our capital. And that's through cycles. We're not talking 2 or 3 years here, we're talking through investment cycles. Now, the previous speaker, and I'm extremely grateful that she put a number of quotes in a presentation, and I've got one from one of the great philosophers of the 21st century, Ron Burgundy, and I think it says a lot. It talks about inflation and the risk that inflation poses to all of us, and in particular, as I've mentioned, through the long term. And inflation has been relatively benign in the last couple of years, not only in SA, but across the world, in many parts of the world. And I think some of the comments made previously about aging populations plays a big part. And to some extent, that lack of inflation has lured investors into a false sense of security. Now, the requirement to invest in real assets, so assets that give us the power to preserve capital through time, was almost seen as so last century, almost so 1980s, 1990s. In a world of falling interest rates and falling purchasing power, there wasn't that need to invest in real assets. But the world is changing, and I think we all know that the world is changing. And the focus for investors when it comes to real capital preservation and growth in our capital should really move away from investments that has benefited from a world of disinflation that was dominated by disinflation, dominated by falling interest rates, to a world where our financial freedom really is going to almost depend on the ability of the investments in our portfolios to grow income over time, to grow the earnings that we can get from those businesses that we invest in over time. And then also where we can get some growth in capital at a pace that is going to exceed the cost of living, exceed inflation. So we need businesses with pricing power. with real cash generation, which grow over time. And we firmly believe that your typical balance fund, where investors need to save according to Regulation 28, is ideally placed to protect investors' capital against this potential of faster inflation in time. And we've heard how there's a lack of real rates in many of the parts around the world. That's not a place to hide. We need to find investments that is going to protect our investors' capital through time. And when we talk about the balance fund as an investment option to investors, we often get a bit of a pushback. And a pushback comes when the minimum returns that has been generated through different time periods are presented. So investors would focus on the worst potential outcome over either 1 or 2 or 3 year investment period. So over 1 year rolling periods, the worst ever return that the Ford Balance Fund has generated was about 17% negative. That's a 1 in 220 event, effectively, with the fund being in operation for just under 20 years. On average, through different time periods, from 1 year through to 10, the average return has ranged from plus 12.5% to roughly 14% per annum. So the questions we would ask investors is, do you really want to give up that potential return of, let's call it 12.5% if we want to be really pessimistic, in order to protect against a relatively small potential outcome or probability of a negative 17% over a short time period, or at worst a 0% outcome over 3 years and longer? And then there's an even better outcome relative to the average or the median, which exceed these average returns by quite a big margin. So do you really want to give up those potential real returns well in excess of inflation through cycles to protect against a relatively small potential outcome of a negative return over shorter time periods? And this slide says a lot. This is the returns through time of the Ford Balance Fund relative to the All-Share Index. And it just shows you that if you invest in the right assets, you make the right decisions, you're able to preserve capital when returns are negative and grow when returns are positive, you are able to generate equity type returns from a normal balance fund, similar to what you can earn from equities through time. And that is a fantastic outcome for investors. You can invest in one of the few asset classes, probably the only asset class through time that has consistently produced real returns well in excess of inflation plus 5%. Now you can do that in a normal balance fund strategy if the investment manager has a good skill in both stock selection, but also asset allocation. But it's not easy. It can be done as we've shown you, but it's not easy. And the real trick, the real skill comes in the ability of a manager to protect against downside risk. So the power of compounding works, but it only works if you don't have too many large negatives. And what we've shown on the right-hand side of this chart is the two relatively negative experiences that both the market as well as the Ford Fund has experienced in the last 20 years. The one was with the GFC, and the second one was more recently, from April 19 to November 2020. And I think the important points to note here is that even though the Ford Fund has not been able to avoid negative returns in totality, which is understandable because we do invest in equities and we do invest in risk assets, there are two highlights to make here. And the one is that your drawdowns has been significantly lower than an equity-only index. And I mean, there's no surprise there, right? It is understandable. We have diversification in our favor. We don't have to look like the index. and we can invest in assets that actually grow at a time where equity markets do decrease. But the important point here is that the recovery to the previous peaks in the forward fund relative to the All-Share Index happens a lot sooner relative to an equity-only index. So we're able to get capital back to the previous peak within a short space of time. And then importantly, by the time the equity index has hit the previous peak, the returns of the forward fund, and I think the same is true for many of the other balanced funds out there, far surpasses the previous peak of the funds. For example, if you go back to 2010, by the time the All-Share Index has reached the previous peak, the forward fund is already 20% above its previous peak. And more recently, by November 2020, the forward fund has been about 10% above the previous peak. So this ability to preserve capital better and then to allow upside to grow your assets through the power of compounding does result in a great real return experience for investors. Now, we don't like to look at things like standard deviations and maximum drawdowns. I've included the numbers there. You can see that, you know, the forward funds typically, as is the case for many balanced funds out there, has a very similar profile in much lower volatility and far smaller total drawdowns. But this doesn't explain the risk for investors, right? It doesn't tell you anything about the future. All it tells you is really the behavior of investors, how they react in times of panic. They sell whatever they can in many cases indiscriminately, and there's always collateral damage out there, but it doesn't explain risk at all. So if you really want to break things down and you look at the volatilities and in particular upside versus downside volatility, I think there are a couple of very noticeable observations to make. And the one is, if you look at just total returns through time, and again, no surprise because I've showed you the numbers, but your total return from a balanced fund is not that dissimilar relative to the volatility of an equity-only index. But what makes the skill of an active manager so important is in this downside protection. And often when we talk to investors and they look at overall experiences, they look at monthly returns or 12-month rolling returns, 36-month returns, and they focus on volatility only, so standard deviation of your returns that you show, they say that this fund is no different from any other fund out there. It has the same kind of volatility relative to return. So why should we invest in this fund relative to another fund? But if you start to break down your experience from a downside participation relative to the market, and this is where Ford has really, I think, earned its stripes through time, it is in the ability to protect capital on the downside. So you can look at negative returns only over 12-month periods, for example, if investors are really concerned about the drawdowns over shorter time periods. And one can see that relative to the All-Share Index, and even relative to many of the other funds in the category, if you look at the experiences of negative returns, and it's only been 24 negative 12-month return periods over the last 20 years that we've been managing money, the observations are quite different from the market overall. So far shorter time periods of drawdown, as I've shown you, but also the numbers are significantly smaller, on average negative 6%, and the volatilities are relatively low. So you are experiencing negative drawdowns that is very different from the overall market. And I think this is the real attraction for investors when they focus on a world that is likely to look very different from the last 10 years in particular. When it comes to actively managed funds and the ability of a manager to pick stocks, you need to focus on these kind of things that's important, and that is protecting against negative returns. But risk management to us is not really about volatilities, as I've mentioned. It is in identifying the right assets at the right time and moving into those asset classes early. So what we've shown here is just the history of our asset allocation over time. And one can see, if you look at the gray area at the top, that is bonds, SA government bonds. And we were early in moving into government bonds in the current cycle. And we were divesting out of cash because of lower real yields available on cash and moving into bonds because bonds offered real capital protection because the yields were so high. And more recently, one can see that we've been selling some of our foreign assets when the rand was relatively weak and equity markets were still relatively buoyant as they are at this particular point in time. And we've invested the proceeds from the sale of those foreign assets into SA equity because SA businesses in many cases were sold down significantly. They were weak. Investors didn't like the SA Inc. story. There were some capital raises by good quality businesses that offered you a great opportunity to invest in those assets. So being able to use liquidity to buy businesses that are cheap, sustainable, can grow earnings over time with the upside from a share price perspective, that is real risk management in our approach. If you look at our philosophy, it is not in trying to manage volatility in the fund. It is in moving into great assets at the right time in order to protect capital. And then there's many other things that we also look at in order to protect capital. And most of them focus on the sustainability of businesses over time. The ability of management teams to identify opportunities for their businesses. We need to back those management teams, but they need to allocate capital appropriately. One example is Naspers. I won't go into too much detail. But then we also want to avoid businesses in sectors that is in permanent decline. If you can avoid those businesses that it's not going to survive, you're far more likely to protect your investors' capital and grow it over time. I think it's another theme that we've seen in the last 10 years. It's just the rise of index funds. And index funds has almost, again, given a false sense of security for investors that you don't need to diversify away from index heavyweights. The future is going to look different. You need to diversify across different equities, different asset classes in order to protect investors' capital.
Well, I'm afraid we're just about out of time. If you have any concluding remarks, I'm sorry to rush you, but unfortunately, we have to, there's a number of other panelists.
Let's carry on. I'll conclude there, Adam, and we can take whatever we need to take forward in sessions.
Yeah, great. Thanks. Sorry about that. Well, there are a couple of questions that we've had from the audience. I'd ask those people to please join our breakaway session with Will and the other balance managers, and we can attempt to answer some of those questions relating to flexible funds versus balanced funds and certain performance metrics that you've discussed there. Thank you very much, and over to Dwayne. Thank you, Dwayne.
Thanks, Adam, and thanks everyone for your time this morning. I think just carrying on from where Will left off, I mean, what I really want to share today is just sort of how to think about markets. And the question I'm asking is, has multi-asset funds lost their mojo? And certainly why I want to talk about less about the product, but more about our views around the market and certainly where we're seeing opportunities to deploy our clients' capital. So, I mean, it's nice to see Adam, like myself, we've been through a number of cycles, and like Adam, I'm certainly with these stressful market conditions, certainly losing a little bit at the top when it comes to hair. And certainly if you look at how investors, and I think this is the important question today.
Dwayne, I'm going to mute you there. You can't insult your panelists like that.
We're in the same boat, Adam. But I mean, again, it's one, how you think about where investors are thinking about how to deliver returns and generate income for their clients, as what we have seen over the last 4 years, where returns have been tougher to come by, and multi-asset portfolios, that certainly is a good financial planning tool, has lost favor with many investors. And the simple message that been communicated is that certainly investors could feel they could hide in cash without taking any risk, and generate quite a good return for their clients, while multi-asset portfolios have certainly lagged. And the whole thing with respect to investors essentially chasing returns, ultimately resulting in flows and suboptimal decisions. So why has investors left the sector? And what I'm showing you on this slide is the performance of the 91 Opportunity Fund, but also relative to the ASISA high equity, multi-equity category. And what you will see from the different data points over both 1, 3, 5, and 10 years, relative to the performance of cash and CPI, that while there's been a recent bounce in performance, certainly if we take an honest assessment of the sector over time, relative to that cash benchmark, the returns have not been good enough in the sector. And the reason for that is ultimately investors have not been compensated for taking risk in the portfolio. Because what you will see on the next slide that I will highlight, if you look at the performance of the growth assets, specifically that investors have got access to invest in, many of those asset classes delivered quite a poor performance. And so therefore, the key message I'm trying to highlight today is just how important that asset allocation decision is for investors and how important it is to get that decision right. And I think the last point I would make on this slide is, while I think everyone is crowing about the strong numbers we've seen over the last year, you must remember at the end of the day, I take a huge amount of responsibility that ultimately I'm managing the retirement savings of individual investors. And when they're looking at their statements on the month-to-month, it's not about what the return was over the last year, as what is the compounded return you've delivered over the longer term period. And so less focus on the short term and more on the long term. And what you will see, certainly with those that have had a quality investment philosophy like ourselves, the last year has been incredibly tough because there's been a rotation in the market away from quality to value and cyclical shares. And we think a lot of that has now run, and we're certainly finding more value in certainly the quality shares that we invest in. But if you look at the important message I really want to highlight, and I think what's top of mind to the investors that I speak to, is there's been a little bit of a whipsaw in the market in terms of trying for investors to think of how can they deliver the returns for their clients. You've got a situation where over the last certainly 5 years, the returns on many asset classes have been subpar. You haven't been rewarded for taking risk. And certainly in the domestic market, domestic equity as well as domestic property, despite the recent recovery, has still delivered suboptimal outcomes for clients. And so what I'm showing you on this slide, again, is the performance track record over different time periods for the different asset classes. And I think the important message for investors to take away is, if you certainly look at the performance of the local equity market, that has been quite buoyant over the last year, delivering a 36.2% return. But the important message, again, you've got to remember base effects. And ultimately, if you look at the performance of that asset class over 3 and 5 years, has still been suboptimal and has underperformed cash quite meaningfully. And therefore, having that allocation to domestic equities would have cost investors. So getting that asset allocation right is quite key. And I think the important message investors have got to ask today is, what is the outlook for domestic equity? The views are so divergent. Some are saying that there's significant value in local equities, and this bounce is only the start of a multi-year recovery. And some are saying the market's run ahead of itself. You need an element of caution. And how investors navigate that uncertainty is quite key. And I will highlight in one of my next slides just how we're seeing the market and how investors should be thinking about returns outlook going forward. Again, property, very buoyant bounce over the last year. But I mean, again, if you look at that performance over the last 3 and 5 years, any investor that would have had a large allocation to domestic property has ultimately resulted in suboptimal outcomes. And I think the learning that investors should take from that for a number of years, and I've managed these portfolios now for a number of years. For a number of years, there was a saying in the market that property could only go up. I mean, it was such a great asset class. It was almost seen as an income asset class rather than the growth asset class. and one again where had investors avoided the property sector, that would have been a great asset allocation call. You then look to the performance of bonds, and certainly bonds relative to cash, despite all the negativity around the fiscus, where we're going as an economy, local bonds have actually done well, and it delivered good returns for investors. And certainly our view going forward is that bonds provide investors with a good proportion of income going forward, but it's not without risk, and therefore needs to be part of a balanced portfolio. I think the key shift that has happened is certainly while over the last 3 and 5 years, cash returns have been quite good, well ahead of inflation. With the 300 basis points cut that we saw in interest rates, now investors can no longer hide in cash and deliver inflation-beating returns. So how investors navigate that uncertainty, certainly we think is quite key. And then domestic global equities clearly has been the winning asset class. And again, the consensus view has been that global equities have run too hard, valuations are full, there's no value in global, and it's all local. Whereas in our view, on a bottom-up analysis, certainly we are finding value in global high-quality equities, and I'll unpack that a little bit later. I think the last point I would like to highlight from this slide is certainly where in the income desert that we've experienced globally, what we have seen ultimately owning expensive asset classes, if the tide goes out, can ultimately cost performance. And while we've been quite negative on the outlook for offshore bonds for some time, it's one where it does now show why investors, when they are chasing the returns, taking too much risk and not thinking about the downside, ultimately can have suboptimal outcomes for their clients. So what are some of the lessons? And if you look at the balding and the aging that has happened over the number of cycles that I've managed these sort of portfolios, what are the pitfalls that investors should avoid when making asset allocation decisions? So firstly, your asset allocation decision is one of the most critical decisions to make in investments. Yes, your security selection is key, but how you get that asset allocation view right is also very important and a key driver of performance. But the message for investors is that you can't make investment decisions looking through the rearview mirror. The past is the past. You're going to tie yourself up in knots if you're chasing the winning idea of the day. So looking at what has worked this year, and let's just buy more of that. Ultimately, having that long-term focus, sticking to your investment approach and philosophy, and looking for the best risk-adjusted investment opportunities is a key decision to make when it comes to asset allocation. So don't get sucked up in terms of the FOMO, the missing out of opportunities, and chasing returns for the wrong reasons. Stick to that bottom-up approach. And then secondly, and I think this is the key one, overconfidence in forecasts that results in risky bet sizes. I mean, I've seen this time and time again. I mean, if you think of even the great investors have got a hit rate of about 55%. So one of the key things you've got to get right is that when you are wrong, that ultimately it does not cost your performance or result in a significant drawdown of your client's capital. So how you think about your forecast, making sure that you've got a wide range of outcomes that you're modeling and that your portfolio can handle different risk scenarios, we think is key. Thirdly, taking too much risk in the pursuit of return. And I think this is the key challenge that investors are going to face in the year ahead. We know that cash returns are low. We can see that in risky assets, the performance is there. And to try and compensate for that is very tempting to just jack up the risk in the portfolio in the pursuit of return. But what we saw in Feb and March 2020, when you get shocks to the system, ultimately, if you've got too much risk in the portfolio, like Warren Buffett has said, then you will know who's been found wanting and been swimming naked by having too much risk in the portfolio and not enough prudence when it comes to capital allocation with respect to portfolio construction and position sizing. And then lastly, I think it's important that investors need to look for the best risk-adjusted opportunities irrespective of where they are. I think it's so tempting sometimes to just have that home bias of looking for the best domestic ideas and almost outsourcing that global decision. And I think the one thing that certainly we at 91 have learned is the importance of that global integration, and when you're allocating these multi-asset portfolios and making those decisions, that there are the best risk-adjusted opportunities, irrespective of where they're based, and fully understanding the risk that you're taking in your portfolio in both the local and the global components. So just the important one, as I start to wrap up, is just thinking about how investors should be thinking about returns going forward. And what I show here is clearly an outlook of where we see returns going forward. And this is our bottom-up analysis done by the team at a security level for the holdings within the 91 Opportunity Fund. And what you are showing with the bars is the range of outcomes, with the top of the bar being our more optimistic scenario, the bottom of the bar being a more conservative scenario, and certainly our base case would be somewhere in the middle. And when we look at this concentration of high quality global equities that have significantly underperformed over the last year, given the rotation to value, we are certainly seeing tremendous value in quality. And in Rand terms, we expect to deliver a healthy return from our global equity markets and believe it needs to be part of a balanced portfolio. And certainly based on our range of outcomes, we think it's incredibly attractive on a risk-adjusted basis. Certainly, we remain constructive around the outlook for South African government bonds, with a preference for nominal bonds over inflation-linked bonds, certainly with the longer maturities. But again, as part of a balanced portfolio, I think it is key that investors need to have a healthy balance based on the very attractive valuations in both South African nominal bonds and inflation-linked bonds, specifically inflation-linked bonds with shorter maturities to provide an element of inflation protection. Certainly, if you look at the domestic equity market, we are finding more value, but certainly it comes with more risk. And I think it's one where investors need to be very selective, because that again shows the power of active management, where while certain sectors of the market we think are certainly quite hot, where the valuations are quite expensive and the downside is quite significant, whereas certain pockets of the market we are finding good value. So certainly given that wider range of outcomes, we think investors need to be quite selective in terms of their domestic equity allocations, but certainly value to be had, and certainly a part of the market that we get quite excited about. Just shifting to domestic property, we remain quite bearish on the outlook for domestic property, concerned about debt levels, concerned about where the market is, and ultimately, unless one thinks that you have got a very bullish long-term macroeconomic view for South Africa and how these property stocks deal with some of the fundamental structural challenges and how they cure their balance sheets, ultimately it's too risky for our portfolios, and therefore we've got a very low allocation to domestic property. And then just lastly, hiding in cash, we think while it does provide an element of optionality, is not going to give you the inflation-beating returns that one would expect. And then global bonds as well as offshore cash, certainly we're not finding value at this stage. This slide just speaks to our asset allocation of the flagship strategies within certainly the opportunity or the quality SA portfolio in terms of both the low risk and the high risk portfolio. And what you would see there is how we've constructed the portfolio that speaks to our asset allocation views in both the low equity as well as the high equity portfolios, with clearly a preference for domestic bonds, offshore global equities, as well as local equities. So in conclusion, with my last slide before I wrap up and hand over back to Adam and Leonard, is that how we think investors need to navigate this period of uncertainty is certainly SA cash is likely to underperform, forcing investors up the risk curve. But we believe that investors need to be cautious without chasing those returns and adding too much risk in the portfolio, so needing a sense of balance. We think the rand has strengthened quite a bit, and certainly based on our view, this time at the rand at its current levels is a good time for investors to be taking cash offshore if you've got a longer term approach. Certainly we think the rand might still strengthen slightly from here, but the easy money has been made on the rand strength, and certainly on our 5-year forecast, we expect the rand to weaken from current levels. The important thing for investors to consider is again having that balance in the portfolio, making sure that you're looking both locally and offshore for those opportunities and deploying capital using a long-term approach, sticking to the fundamentals, and again, making sure you stay true to your investment process. Local equities certainly offer, in our view, selective upside, and we get quite excited about some of the higher quality shares in the local market that has been sold off to where investors have sought more cyclical, higher risk, higher beta exposure. And so certainly we're finding it more exciting to deploy capital in the local market. And then just lastly, quality as an investment style. We've seen this before. We've managed these portfolios through a number of cycles. Quality at the end of the day compounds over time and in the long term. And certainly when we look at valuations today, our holdings are pretty much trading at decade lows relative to the market. And certainly we feel we've bottomed in terms of the alpha cycle of more shorter term underperformance. So then just the last comment I would make is certainly what the last cycle has shown us is the importance of allocators to have a balanced approach, to know what investment style you are following, to know your manager, to stick to your investment approach for the long term, to not be swayed by all the market noise and get sucked up into what is work currently, stay focused on the long term. And ultimately, we believe that the multi-asset portfolios are not dead. They're an important financial tool for advisors and gives exposure to investors in terms of those key asset allocation decisions that need to be made. So thanks everyone for your time. And then Adam, back to you.
Thank you, Dwayne. Some very strong views expressed in the Q&A. And again, I would urge all the participants to join our breakaway because we're going to try and answer some of those very strong questions left by the audience. But we're running short of time, so please go ahead. Leonard, we look forward to your presentation. Apologies for running slightly overdue there. Thanks.
Right. Thank you very much, Adam, Dwayne, and William before me. Ladies and gentlemen, I trust that you can all hear me. So thank you very much for your time this morning. Going last in this panel, I'm hoping to share a little bit this morning with you around seeing a little bit of a balanced fund process, having a plan, and how that actually moves in action. So William and both Dwayne already touched on a number of things that will be very familiar to all of you that have followed the South African market very closely over a number of years. And I think this first slide tries to illustrate the importance of why valuations matter and why the difference between value and price is a key thing for investors and asset allocators and asset managers to understand when thinking about investing and allocating assets within a balanced fund. So what this chart that I've put up tries to illustrate is the price of assets over a long time period. And I've shown you the S&P 500, the World Index, and South African equities on a price to book basis. And you can see how those fluctuate over time. And then in the blocks, I've showed you the returns. So the value that you've actually been able to achieve over a long time period. So in the first decade of the 21st century, South African assets, as you can see on the chart, was very lowly valued relative to the world and the S&P. And your subsequent returns, so the value that you bought by buying at that cheap price, resulted in a very attractive return in South African rands compared to those other alternatives. If you then fast forward to the second decade of the 21st century, you can see that those valuations had actually sort of migrated to a very similar level, and that over the subsequent 10 years, the returns again have been very different, and South African assets have disappointed relative to global equities over that time period. And that sort of alludes to the point that Dwayne was making, that taking the risk over the past 5 years in South Africa certainly hasn't paid investors a significant or a reasonable real return after taking account of inflation. So where were we at the start of 2020, just before the coronavirus really hit markets in their full extent? You were already witnessing quite a difference in the valuations between South Africa, the rest of the world, and the USA. So what our plan and our process at Prudential then implied was that we needed to start leaning into these equities. and hence the experience of February was quite severe. Another way to look at the valuations will be on a price earnings basis, and this just looks 12 months forward, so it's a forward PE basis, and you can see that divergence that we've seen since 2020 has opened up even further. And they really started diverging already in 2015. And that really explains a large part of the underperformance in the past 5 years to the start of 2020 between South Africa and the rest of the world. A lot of it due to our local circumstances, but also just really emerging markets falling very much out of favor. So our Prudential Fund and many of our other asset allocation funds going into 2020 was observing a lot of these valuation dispersions and discrepancies already. And we were starting to lean into these more attractive valuations, believing that the risk-reward profile was now in our favor. But as we all now know, is that, coronavirus struck, and for a period of 4 to 6 weeks, the financial markets went into a flat spin. And here it is so important as an investor, as an asset allocator, and as an asset manager, that you need to have a plan when you are hit in the face. Like Mike Tyson also said, is if you don't have a plan, I'll gut you like a fish. So what was very important in the turmoil of February and March last year is to actually have a plan and stay the course. And what I want to try and illustrate over the next couple of slides is how we at Prudential managed to stay the course, keep to the process, stick to the plan, and actually lean into the opportunities that have presented ourselves. So what this graph then shows you is how significant the recovery has been by staying the course and not selling out or not capitulating at the bottom due to fear in March of 2020. And where we are today at the end of April, actually, if you go back to the start of 2020, investors have enjoyed a very, very healthy and significant real return after inflation, despite the drawdown that was witnessed and experienced in February, March. So let me show you a little bit of the process in action. So with the dislocation that happened over the past year, there were significant opportunities in many different terrains to actually make what would hopefully be, in the fullness of time, attractive investment changes and positionings to the portfolio. So the first one was in the currencies. So significant dislocation in currencies created opportunities for an asset allocator to move their foreign exposure. So what I show you on this chart on the screen now is where we increased or reduced our foreign exposure over the course of the last 2 years. What you can also see in the numbers is on the various points is the total size of the portfolio at those various times to offshore assets. So you can see the rand strengthened quite meaningfully going into the start of 2020. We were trading around about the levels we were now, below the 14 rand to the dollar, and we increased our foreign exposure. As the rand sold off very significantly February, March, April to beyond 19, you can see that we reduced and we actually brought a lot of money back into our portfolios. So at the end of April, the exposure to offshore assets were only 24%. Quite a bit less than a lot of our peers, which allowed the currency to actually run and increase their already very high levels of offshore exposure. As the rand has subsequently recovered, we have again started to increase our offshore exposure. And as at the end of April, we were sitting at just over 30% of our assets in offshore. This includes some foreign currency swaps that we have moving rands into foreign currencies. And I'll allude to that a little bit later on why that is. So significant opportunities in currencies. We also saw a lot of opportunities between asset classes. So on this chart, I show you the forward real returns between South African equities, global equities, and South African cash. So Dwayne already alluded to that period of 2017 to 2019, where investors were actually compensated quite handsomely by just sticking to SA cash. With interest rates coming down so significantly, there's almost no return or even negative real returns in SA cash at the moment. And so what you can see what we have done within asset allocation is this dislocation or this relative movement between asset classes has given us an opportunity to move into more South African equities over the past number of years, as well as out of cash into alternative asset classes. There are also lots of opportunities presented within asset classes. So this specific example looks at the South African equity example. And what I've done on this chart is to show our portfolio exposure to the so-called SA Inc. names, the names that you would typically associate with mostly South African economics and South African fundamentals. And what I show with the red line is where our relative exposure to the CAPSWIX index has sat over time. And what you can see is going into 2020 and into 2021, we have significantly increased our relative exposure to South African equities, as that negativity that Dwayne alluded to about South African specific has sort of been manifesting itself in the share prices. So the prices now actually demonstrate value to us in our portfolios. So the largest exposure there being in South African banks, but as you can see, we've also reduced the underweight to the likes of the general retailers, where for a long time we didn't see significant enough opportunity in that space. So I think this is going to be very interesting when we get to the breakout room later, because you can tie this back to some of those numbers that Dwayne shared with you earlier. This is the prudential view of the potential real return prospects from the various asset classes, and what we use essentially to largely frame the starting point of building a balanced portfolio. What you can clearly see between the left and the right-hand side, South Africa versus the world, is that the prospective real returns for South African assets, we believe, are higher than their fair value at the moment. That means we believe they're attractive at this point in time. If you contrast that to the world on the right-hand side of the panel, of course, there will always be opportunities, individual opportunities in different world markets or individual stocks, but on average, we see quite limited potential for very, very attractive disproportionate real returns. And I think that's a little bit different to perhaps some of the messages that you would have received from Dwayne. What you can also see here is on the very left-hand panel is that South African cash, we believe, is unattractive at the moment. And so moving into more cash proxies in the linker space and the nominal bond space is something that we have tried to exploit in the portfolio with the real returns on offer on both those asset classes. Similarly, on equities and property, property a little bit less so in terms of equity, the relative attraction versus where we believe the long-term fair value of these asset classes will be. And we can unpack some of that during the Q&A if you have any specific interests. So the important thing, however, is those are just an estimate. That's a best guess, but we understand that there's a distribution of possible outcomes. And what is important for us to understand when constructing these portfolios is to understand the potential distribution of the various asset classes and to pick these individual asset classes to hopefully build a portfolio that can withstand shocks, but also benefit from the upside and get a more normalized distribution that will exceed that of its benchmark over time. So if we just very quickly unpack some of our observations and some of our thoughts on the individual asset classes, like I would have alluded to on the previous slide, you can see that cash, we believe, has got a right-tailed distribution at the moment, and that the real return prospects in most likely scenarios will be quite low real returns from here on. That is exactly the opposite to what we believe is the potential for South African equities, where we have a very strong left-tailed skew in the distribution. We believe there's a high likelihood that real returns will be attractive over the medium term. Property is a very contentious asset class at the moment, and we think there's a good argument to be made that you have a twin peak distribution essentially at this stage, where the balance sheet and the structural fundamental issues that have evolved because of COVID will be a problem for a lot of companies that, for instance, don't have a strong balance sheet or a strong geographic distribution of properties across the countries or the sectors. But we do believe that the prices, the fundamentals of price and valuation has moved very, very, very significantly, and that there are individual opportunities within the asset class where the likelihood of a high real return is actually quite high. So select opportunities within property, and we are moving our assets in those directions where we find them. And then lastly, you have inflation-linked bonds and government bonds. Government bonds introduces a little bit of a distribution peak to the left, because you're essentially taking on the risk of future inflation. But certainly the base case would be for high real returns, given our starting point of yields today. So just in conclusion, where are we positioned as at this moment, given this opportunity set, given the plan and the process that we have in the Prudential Balance Fund to generate this normal distribution that hopefully generates real returns in excess of a benchmark. Roughly half of the portfolio in South African equities, a very large allocation to South African bonds, and around 20% in foreign equities. As you can see again there on the slide, I've illustrated the total equity and the total foreign exposure, including the foreign exchange hedges, where essentially where we're sitting today, because South African cash is essentially no longer generating that real return without taking risk. They're essentially very similar to offshore cash, also not generating a real return. So the diversification of moving into dollars and euros, etc., where you also not paid to take the risk, we actually prefer to take some of the currency and hopefully benefit from that diversification in the portfolio. The top 10 holdings you can see on the right-hand side. Naspers process, you will see still our top position, just under 7% of the fund, and the top 10 shares making up just over a quarter of the total portfolio. So half essentially of the SA equity fund, or of the SA equities exposure in the portfolio. So thank you very much for your time. Important to stick to your plan. When you hit in the face, stick to your process, and that way we've managed to, we believe, actually generate a very good recovery in a market because we stuck to our guns. Thank you very much, Adam. Back to you.
Thank you, Leonard. Thank you very much to all the panelists who joined. And as I say, we'd urge you to join our Q&A, our separate breakout session, where you will have an opportunity to ask some of the questions of the various portfolio managers. I know there have been some strong views expressed in the Q&A section, some important questions. Thanks again, and I'm now going to turn the mic over to Eugene. He has a couple of announcements to make just before we break.
Many thanks, Adam and William, Dwayne and Leonard. That was most interesting, definitely. Rear view mirror driving, definitely not working. And the message, sticking to your plan, echoing throughout. I mean, we've seen it so many times when people sell out of funds for all the wrong reasons, the wrong time. So stick to the plan. I suspect the breakaway room can be very interesting, and I've seen Adam in action, so could be a couple of hard questions coming through from his side as well. So looking forward to that. Just a reminder to our audience, a free Excel masterclass gift offered by Excel Academy. Dan and his team, the details are being posted in the chat room again, so go have a look there. We'll now break for tea until 11:25. And after tea, we will start with the top international managers like Anchor Asset Management, Credo Wealth, Orbis, Goldman Sachs. So also some very interesting managers coming through there. So grab yourself a cup of hot chocolate in the foyer and some snacks prepared by your own caterers. So see you all back at 11:25 sharp. Thank you. Right, some good tunes there, DJ Dan. Thank you so very much for that. You can't help but not to jive to it. Right, up is next is our global equity panel, and joining us again is Pierre de Klerk, Managing Director from Boutique Investment Partners, to introduce the panel on global equity. Pierre, thank you so much for joining us again Looking forward to your panel in the introduction thereof. Thank you.
Thank you very much, Eugene. Moving on to the king of asset classes, global equity. And that's my attempt to lead into Nick Dennis's presentation, which has a Alice in Wonderland theme and looks to be very entertaining. So first up, we've got a full set of 4 speakers, so my introduction is going to be very short. First up is Nick Dennis from Anchor. He will be followed by 2 value managers. Firstly, Jared Khan from Credo, and secondly, followed by Fiona Jeffrey from Orbis, and they will speak to us about what to expect about the value, the continuation of the value rotation going forward, and hopefully answer the question whether value is a style to hang on to for the foreseeable future. And then lastly, the 4th speaker will be Luke Bars from Goldman Sachs Asset Management, who will speak about thematic investment and how they believe thematic investment can be incorporated into an overall portfolio. So I think we can try for a smooth, seamless transition between the speakers. Once Nick is done, Jared, you can seamlessly take over. Thank you very much. Looking forward to the presentations.
Right. Thank you, Pierre. Thanks for the introduction. Yeah, and thanks BCI for having me, and good morning to everyone. So I think people have a strange sense at the moment that the market has is not quite normal and not quite usual, and maybe you've had a sense of this for a while. And it seems like we've gone down the rabbit hole or through the looking glass and into a wonderland or a strange kind of world. So I'm going to talk about what's going on and how I, as a fund manager, respond in that environment. So we start, what are some of the signs that things are not quote unquote normal? And so if Alice were to look at market valuations today, which just seem to have climbed over the last decade with a few short-term interruptions, but valuations have just gone up and up and up. And Alice might describe the situation as most curious. And then if you look beyond the equity market and you look at some crypto assets just over the last year, everyone will know that Bitcoin has done phenomenally well in absolute terms and certainly relative to the equity market like the S&P 500. And then you've got something like Dogecoin, which really was set out as a complete joke, and that has smashed Bitcoin. And people know it's a joke, and yet it's done phenomenally well. And the strange thing is that as it becomes more widely prevalent, the irony is that it's becoming less of a joke, and people are talking about it actually becoming a more widespread store of exchange and potentially a sort of more sustainable asset. So no strong views in that, but just to highlight the kind of the environment that we're in at the moment. So what are some of the causes behind some of the strangeness that's going on in the market? So I'm going to try to identify a handful. So the first one, which most people will identify, is the impact of monetary policy, certainly post the global financial crisis. And that's really setting interest rates at sort of nailed to the floor, essentially at zero. And that's where the phrase comes up, TINA, or there is no alternative. So with rates so low that pushes people out onto the risk curve, and into stocks and into crypto and into all sorts of assets. The next major contributor, I think, is a shift in fiscal policy. And we saw this in the response to the COVID crisis. So fiscal is taking a larger and more dominant role. And certainly there's been a dramatic shift in size and impact, at least relative to the global financial crisis response. And I think this is going to become a more structural part of the landscape and something that we're going to have to deal with. And so it's it'll be interesting to see in the next recession that's sort of not caused by a global pandemic, where the fiscal authorities will directly mail checks to people like they had this last time. Another emerging phenomenon that is more recent is the return of retail investors. And they were previously thought to be really lost to the market. But now I think driven by low or no cost brokerage on platforms like Robinhood, retail investors are coming back to the market, and particularly young millennial or Gen Z investors. And you saw this phenomenon sort of really vividly captured with the whole GameStop episode earlier this year, where it went up, I think, 20x at one point in time. And I think these investors are here to stay in, and I think they will have an impact on the market, and they will drive, I guess, pockets of mini bubbles and pockets of froth. But I think they could have could drive multiple sustainably high in certain parts of the market. Fourth, you've got the impact of passive investing, and it's well known that that passive has become a greater part of the market over time. Why this is important is because passive is a value agnostic buyer. If a share price goes up, say 1,000 times in a day, passive is still going to be buying tomorrow, even if the valuation has gone up 1,000 times. They don't care about valuations. So the more passive, one could make the argument that the more there's an argument that we'll see greater and greater valuation inflation. And then finally, I think what COVID has really highlighted, and this is both in the financial markets and in the real world, technology and disruption is accelerating at a greater and greater pace. And I think this adds to the sense of, our feeling that, the world is changing, it's not as it was, and it's quite unsettling for a lot of people. So what do you do in this environment? Well, I can tell you what I'm doing in the focus of the strategy in the Anchor Global Equity Fund. I am laser focused on finding what I call multi-baggers. Well, this is actually Peter Lynch's terminology. So a multi-bagger is a stock in a company that can go up 5x, 10x over the next, say, 5 or 10 years. So you think back to companies like Netflix, Amazon, Tencent over time, these kind of companies. And what I'm trying to capture with this image is that to find these multi-baggers, you need to use both sides of your brain. So fund managers are traditionally quite left brain centric, very spreadsheet driven, very logical. But I think to find these multi-baggers, I think you need to lean into creativity, you need to lean into intuition. And I would call it, you need to have one foot in the real world, and you have to have one foot in Wonderland. You've got to think in an unorthodox and creative way. So with that said, we've got this world of increasing change, where things don't necessarily make a lot of sense. So how do I apply this multi-bagger philosophy? And if there are very few pillars that we can kind of hold on to in this world of increasing change, what can we hold on to? And so I still look to, I think there are still a few fundamental principles that drive value creation for companies and for society. And then ultimately they lead to wealth creation in the form of higher share prices. So where does it start? Ultimately, if you've got a company like Netflix or Amazon or Tencent, it all started with a better product that was superior on one dimension, whether that's cheaper, more convenient, greater selection. And what that better product means is that company gains market share over time. And as they gain market share, they get more revenue, more cash flow. And what these multi-bagger companies do, what the great companies do, is they take that excess cash flow and they don't pay it out as a dividend, or they don't spend it on buybacks. They take that money and they reinvest it back into the product. They hire the best people, they spend it on research and development, and they spend money on distribution and marketing and getting that product into more hands over time. And so that leads to a faster and faster turning circle. And what I think over time is that the market underestimates just how long and just this process can go on for, and just the size and impact of this process. So what are some of the multi-baggers sort of both looking retroactively and potentially prospectively look like? So this is the top 10 of the fund. I think it is probably, you could agree that it's quite unorthodox relative to a lot of other funds. There's a lot of characters that seem like they are from the world of Wonderland. And so if you'll recognize perhaps some of them, I'll point you out. So the second largest holding is Tesla, and it's certainly one of those unorthodox and controversial stocks. And it's led by an unorthodox and controversial leader. And I thought it was quite funny that you could refer to him as the Mad Hatter of the piece. But I came across this wonderful quote from the book Alice in Wonderland, where the Mad Hatter says to Alice, "Have I gone mad?" And Alice says, "I'm afraid so. You're entirely bonkers, but I'll tell you a secret, all the best people are." And I think there's more than a kernel of truth in this, where you think back of Steve Jobs or Jeff Bezos, certainly Elon Musk. These characters are certainly unorthodox, and they've created unorthodox and hyper-successful companies. And I think that the two are sometimes can be joined at the hip. And now you look at the Cybertruck, which is likely to be launched sometime next year, and certainly it seems to me that this is a creation from the mind of a Mad Hatter. But I'm really excited about this vehicle. It's certainly not going to be for everyone. It's not everyone's taste, but I think this is going to be a mega seller. And so you look at Tesla, people would say, well, it's a bubble, it doesn't make any sense. I look at the company and I say, I think that they, over the next 5 years, they could grow delivery potentially, let's say 5 times, and maybe even 20 times over the next 10 odd years. So I think there's an enormous amount of growth left for this company. Electric vehicles or battery electric vehicles are just 3% of the market. I think ultimately over time that goes to 100%. And that's and to replace the entire global car park of cars relative to today, that's a roughly 700 times increase. So I think there's a long runway for Tesla to go. And I'm not even going to get into all the other parts of the business which start to look like science fiction. For example, robo-taxi. And so as you start thinking about these other things, it is from another world. It is you start getting into Mad Hatter territory and Wonderland territory, but I think that's where the real magic is. This is just a snapshot of the fund's performance over time. We were very long and still are long, a lot of companies that did really well last year. And I remain very bullish on our company's prospects looking forward. So just to summarize, there's often a kind of a cynical saying amongst fund managers that it's like it's never different, or what's it, the four words that you got a question in investing is that this time it's different. I would counter that by saying it's always different in some manner. I think there are structural impacts, which I described earlier, that are changing the nature of the market. And so I would say, keep an open mind. I think the world does change, and sometimes it is different. Next, I think people shy away from these polarizing figures like a Jeff Bezos or an Elon Musk. I don't think that's always the right approach. I think sometimes there is magic in the madness. And then finally, what am I trying to do in this world gone mad, this Mad Hatter world? Well, partially I lean into it and I say, what could be changing? And so I'm focused on these multi-baggers, and I'm focused on the fundamental truths of value and wealth creation. And so those are my tools for understanding and dealing with a mad hatter market and a wonderland world. And hopefully that's helpful to you. And with that, I'm going to turn it back over to Pierre. Thank you.
Okay, Pierre, you just need to unmute.
Thanks, Dan. Thank you very much. We received some questions, but I'm going to keep them back until the end to make sure we give all the speakers enough time. So Jared, we can go straight over to you. Thank you.
Thank you, Pierre. Yeah, once again, thank you very much for inviting me here today. So the theme today is really our perspective on global equities and where we're thinking about the next 12 months or 18 months. And I'm going to effectively just concentrate on three themes. One is the success of the vaccine rollout and what that means in terms of a new normal, in terms of just going back to a normalization of interest rates, the rotation that we've seen so far from work from home, high value tech stocks to value, and will this continue? The new elephant in the room, which is inflation, and how that affects value versus growth, and where you should think of being if we do get an inflation shock. And then something a little bit softer now, but obviously what was worrying the markets quite significantly was the Biden presidency and his policies and how that would affect the positioning of some of the positions in our fund. So Credo Wealth, we're an asset management company. We have a range of UCITS funds and managed portfolios, 4.2 billion under administration. We are London-based. We do have offices in Johannesburg and Cape Town, and we have significant relationships with over 100 financial intermediaries. So interestingly, if you fell asleep in December 2019 and woke up today, markets have been unbelievable. In fact, you would have made about 35% on the S&P, but it's not quite as easy as that as we know it. In fact, the pandemic between February and March 2020 saw a precipitous fall of about 40% in the space of 6 weeks. And the fortunes of people was not as great as this market may point out. In fact, there was a massive divergence in returns. And that divergence, as we know, was the play out between the work from home stocks versus the old cyclical stocks that couldn't operate. So if you just look at the performance of some of the sectors during the pandemic, you have companies that were basically doing exceptionally well. Amazon, retailing, technology, software and services, semis, pharma and biotech. These were companies that operated very well. And as I suggested, the banks, energy, consumer services, and insurance not performing well as they weren't able to operate. But if you push that forward and you look where we are today, just 6 months since the beginning of 2021, the blue lines, which were the worst performing stocks of the first half of 2020, have now become the best performing stocks. Granted, they've become off a very low base, but energy, banks, diversified financials, and that has been the key rotation out of what one may argue highly valued growth companies into the opening up trade of value and other. And that's led to massive divergence in performance. And this has really been precipitated firstly by the success of the vaccine rollout. And I think people underestimate how important this has been, how successful it in fact has been, and where it goes going forward. So yes, there've been stop and starts. We've had, controversy over AstraZeneca, J&J, and Sinovac is the latest casualty with, cases like Chile and Seychelles, and in terms of the success. But without a doubt, the mRNA vaccines, Pfizer, Moderna, have been hugely successful. And all I really want to point out in this graph is the fact that by September 2021, most developed countries, UK, US, Europe, Canada, Australia, and Japan, will have at least 60 to 70% of their adult population vaccinated by one dose. And we know that one dosage definitely helps. It prevents hospitalization, serious illness, And in fact, in most of these countries, they're already on the second dose and will be at that stage. So one must assume that certainly by the end of the year, most of the developed world will have eradicated to a large degree most of this virus. And yes, we have the Indian variant and the Brazilian variant, South African variant, and we've seen the effect of that. But to date, none of this has really derailed the success of the rollout. And yes, you sit in places like Brazil and South Africa today where the rollout's slightly behind, but we're getting to that point. And I think with the movement of the FDA and the movement of companies like Moderna in terms of bringing new ingredients and being able to be reactive, they will be able to deal with any variants. And therefore, you have to believe the rotation back into the opening up trade will continue, and we should get back to some kind of new normal. Now, what does that mean? Well, one will argue, you know, the big hits of the work from home environment, the habits of, you know, being on Zoom calls. Are you going to retain your Zoom membership? Are you going to retain your Peloton and maybe, you know, go back to gym? But that aside, you know, one has to assume that there must be some kind of normalization of interest rates at some stage. And we've seen how the US economy has bounced back really strongly. If you just follow the left graph, US GDP fell off a cliff, as you would expect, early 2020, but it's rallied really hard. And with that, you've seen a few anomalies where there's been a big imbalance between supply and demand, leading to what, you know, many people may think is inflation. And likewise, if you just follow the US rates, we know that the Fed is reactive, they're not proactive. And the overnight rate has really just followed where GDP is. And clearly the overnight rate has not moved yet. And the questions are starting to appear as to, does the Fed need to be a little bit more reactive on the front end as well as on the long end? And then we just, you know, spend a little bit of time on the Fed. You know, we know that over the last year and a half, the amount of money supply through stimulus and liquidity across the world has been unprecedented. And this has further created anomalies in the market. In the wage market, you're seeing some figures that are a little bit puzzling. You're seeing, you know, alternative currencies, fiat currencies to, you know, Bitcoin and Dogecoin, as have been alluded to. So the market's a little bit wary of all of the stimulus, but, you know, like naughty kids, we've become used to just getting more and more of this drug fed to us. And the minute there's a little bit of taper tantrum, you see the markets react really unfriendly. So inflation, that's really the big elephant in the room and everybody's talking about right now. And you can see how inflation has crept into the market. If you just look the top left side there, agricultural and metal prices have rallied massively over the last 6 months. If you look at container shipping prices, they've trebled. A lot of that can be explained by this mistiming of supply and demand in terms of where you have a shortage of supply on the one hand and this huge pent-up demand, and a mismatch in terms of the opening up of certain economies, which has led again to certain anomalies. And that's why the Fed has used the term, this is transitory. This is something that will pass through the system as we get the supply and demand balance coming back into place. But it's certainly affecting businesses. And if you look recently at some of the commentaries from big S&P 500 companies, Chipotle, Halliburton, Southwest, even Kone, which is a big Scandinavian country, talking about steel prices, it is affecting the input costs of these businesses, which affects margins, which ultimately they can or can't pass on to consumers and leads to either lack of profitability or high inflation. But again, the Fed, you know, is holding tight and it's looking at one of them, probably the major indicators, which is the labor force. And there seems to be a lot of flex in the labor force. But as I mentioned before, a lot will turn on whether people are staying at home and not really looking for jobs or not. But it's certainly something we need to look at. And the real question is, can you take the risk of being in growth strategies when inflation actually surprises you on the upside? And you can see on bad days where there are inflationary fears, the market scares off. This was on the 11th of May, terrible day for equity markets. And here's the crux of it, you know, the value growth relationship relative to the 10-year Treasury. If you follow the black line, December 2020, the US 10-year was trading at 0.9. It doubled in the space of 2 months. If you look at the relationship between value and growth, the value index had a massive rally correlating to that uptick in the Treasuries. And that's something you need to be concerned about. Why? It's because people use a DCF model when they value high growth companies or any companies. And if you take the R, which is the rate, the interest rate variable in there, if rates start moving up, the valuation of high growth companies gets far more affected than value stocks, and hence why you've seen a sell-off in growth recently. And then again, just long term, you can see there's a massive, massive runway for the relationship of a rotation back into value. And I'm just going to focus really on the last 5 or 6 years, where you can see from 2016 to 2021, the massive outperformance of growth versus value. And this was really accentuated in the first 6 months of 2020. And as we've had the vaccine rollout, you've seen a strong fight back from value. But even if we just get back to trend, which again is not assuming that value outperforms growth over the longer term, we can still see at least a 30 to 40% retracement back to trend of value versus growth, which leaves me very comfortable as a value fund manager that we are certainly in the right strategy, and we have the downside protection if we have an inflationary environment. Furthermore, if you look at the correlation of valuations, growth stocks are looking excessively expensive versus value. Then the last theme I just want to quickly touch on is the Biden presidency. Coming into the election, there was a big fear that Biden was going to basically steal from the rich and give back to the poor. And if you think of some of the policies that he was implementing, the defense budget, worrying that he's going to cut the defense spending, and this actually hasn't transpired. If anything, we've seen him increase defense spending, and he's moved the budget somewhat. Medicare for all, the healthcare system, worries that he was going to take money and completely change the way Medicare for all was going to be. How would that affect the private medical sector? And then more towards the corporate and individual space, tax raises and how that would impact the profitability of companies and clearly also individuals. But like most things in life, it's about traveling and arriving. And what we've seen is, in fact, it's been quite the opposite. The first 100 days of his presidency has been the best performing S&P since the Great Depression, outperforming Donald Trump, Barack Obama. And it's really been quite a good time for the S&P and for the Biden presidency. So just tying this all up quickly in terms of where one needs to be positioned in a normalized environment where interest rates are likely just to get back to where they've been before, or if we get to an inflationary environment where we have hyperinflation and shocks to the system, one needs to think about asset allocation. And this just gives you a snapshot of where we are today. So clearly, where do you want to be from an inflationary hedge point of view? Well, financials, 25% of our portfolio is spread across a range of financial companies, from the likes of Wells Fargo to Spurbank to Prudential to insurers to specialist financials to Chicago Mercantile Exchange. We've got the sector quite well covered. Healthcare, 15%, another sector which we believe has pricing power and is a necessity. People will have to continue spending money on health, irrespective of whether there's pricing. Other sectors where you want to be are other pricing power. So consumer staples and consumer discretionary, things like luxury goods. Doesn't matter what the cost of a new Hermes bag is, people will continue spending money. Likewise, tobacco and alcohol, companies like Diageo, Imperial Tobacco, Jose Cuervo. These are relatively price insensitive stocks. And then commodities. We are relatively underweight commodities, but we do have 4% holding in energy. And ultimately, you want to be in companies that have pricing power or have cost plus built into them. So industrial companies, our biggest holdings like Raytheon and Northrop Grumman, have long contracts, 20-year contracts with the US government. These are cost plus. It doesn't matter where inflation really goes, because they just add this on to the overall price of these products. So we believe to a large degree, we are relatively insulated against an inflationary environment. And clearly what's, we've seen over the last 6 months is the market has been in a little bit of la-la land in terms of thinking that interest rates are going to remain close to zero forever, that the Fed is just going to keep stimulating and creating liquidity. And any shock to the system, and you see how quickly things change. So we believe we're very comfortably positioned going forward, and we'll be able to put up with most types of environments. And there's a quick snapshot of our 3-year performance You know, as I've alluded to, the fund is a value fund, yet we've managed to stay on pace with the MSCI. In fact, we've beaten the MSCI relative to a value index. We've massively outperformed value strategies. And the reason for that is the qualitative nature of the value stocks that we put in our portfolio. So if you're looking for an investment that gives you MSCI type returns, but has definitely a skew towards a value bias, this could be a fund that you could certainly look to put in your portfolios. So in conclusion, long only equities, global equity exposure, large cap, we can liquidate our portfolio in about 3 hours. Value bias, high liquidity, no special derivatives, gearing or hedging. So with that, I've got about 35 seconds. I think it's a good time to hand over to the next speaker. Thank you for listening, and I'll be around to take questions a little bit later.
Thank you, Jared. Certainly good performance from your fund shown. We can hand over to Fiona from Orbis.
Thanks very much, Pierre. So yeah, thanks very much for having me today. My name is Fiona Jeffrey. I joined Orbis about 6 years ago after spending the first part of my career at Allan Gray in Cape Town. And I work as a product specialist on our global equity strategy, and I'm also a client relationship manager. Before I get started, I just wanted to apologize in advance if I sound out of breath at times. It's not because I stopped exercising in lockdown, but because I am 6 months pregnant. So let me get started. There are 3 things I want to talk to you about today. So the first is I'm going to take a look at passive funds, which track a global benchmark like the FTSE World Index, and assess whether they really are all that diversified today. I'm then also going to take a look at the current market environment and question whether investors are betting on the status quo enduring. And then finally, I'm going to look at how you would go about finding value in this environment and how you might build a resilient portfolio that can handle multiple future outcomes. So let's start with diversification. I think one of the most well-known rules of thumb when it comes to investing is don't put all your eggs in one basket. Generally, this is good advice. The more eggs you have and the more baskets you have, the better your chances are of spreading investment risk. Now, of course, to build a diversified portfolio, you don't just need to have lots of things in the portfolio. You want those things to react differently to the same event, so you want them to be uncorrelated. Now, surely, a passive fund which tracks a global benchmark like the FTSE World Index, which has thousands of stocks invested across multiple regions and sectors, would be pretty diversified. And normally we'd say yes, but if you take a look at the FTSE World Index today, we think there actually might be quite a few eggs in that one basket. Now, how did we reach that conclusion? Well, if you look at the FTSE World Index, 15% of the index is in the top 10 names. But we then dug a layer deeper and took a look at what types of names are actually held in the FTSE World Index. And in order to do that, we used this framework. It can provide a bit of a visualization of what you're getting when you're buying a passive fund. So I use this framework throughout my presentation, so I'm just going to spend a little bit of time explaining exactly what I've done here. So what we did was we took all the stocks in the FTSE World Index and classified them on 2 spectrums. The first was economic sensitivity. So we looked at how sensitive stocks were to movements in the economy, and those that were more cyclical, we put on the top half of the chart, and those that were more defensive or less sensitive to the movements in the economy, we put in the bottom half of the chart. We then also looked at valuations, and stocks that were cheaper than average, we classified as value and put on the left-hand side of the chart. Stocks that were more expensive, we classified as growth and put on the right-hand side of the chart. And that gave us the 4 quadrants we can see on the chart today: value cyclical, value defensive, growth cyclical, and growth defensive. Now, this next slide just gives you a bit of a flavor of the types of companies that might fit into each of these quadrants. If you start in the bottom left, you've got British American Tobacco. That's a classic defensive stock. People tend to smoke regardless of what's happening in the economy. It's also cheaper than the average stock at the moment, and so is value defensive. Then you've got Toyota, which is a classic cyclical stock. People buy more cars when the economy is doing well. It's also cheaper than average, so is a value cyclical stock. We've then got LVMH. LVMH sells luxury goods, famously Louis Vuitton handbags. Now, people will only buy a new Louis Vuitton handbag if they've got lots of spare cash. So it tends to be more cyclical in nature. It's also higher or more expensive than average, so it sits in that growth cyclical bucket. And then finally, in the bottom right, you've got Apple. Apple's earnings aren't really dependent on where we are in the economic cycle, but rather where it is in its product cycle. Is it making good phones that people want to buy? And in that sense, Apple is a bit more defensive. It's also more expensive than average, and so sits in the growth defensive bucket. And interestingly, a lot of the companies that benefited from the lockdowns last year, or the lockdown beneficiaries, sit in that bottom right-hand quadrant, or the growth defensive bucket. So let's now take a look at the FTSE World Index and see how diversified it really is. So what I did on this chart was just take all the stocks in the FTSE World Index and classify them into one of those 4 buckets. When you look at this chart, the index does look quite diversified. There's a nice even spread across all 4 quadrants. But when you buy a passive fund tracking a global index, this is not what you're buying. You're buying a fund where individual position sizes would be weighted based on the company's market cap or the weight in the index. So when I change the size of each dot to represent the weight in the index, you get this picture. And all of a sudden, the FTSE World doesn't look quite as balanced as one might think. You can see there was a clear shift down and toward the right. And in fact, 50% of the benchmark sits in that bottom growth defensive bucket. This doesn't seem all that balanced to me. Now, the benchmark hasn't always been this unbalanced. If you go back 5 years to April 2016, there was a more even spread across all 4 quadrants. And going back to April 2006, 15 years ago, it was even more balanced. But of course, this is not the first time the benchmark has become quite unbalanced. Going back to April 1999, at the height of the tech bubble, we can see there was a similar concentration in that bottom right-hand quadrant. And we all know how that turned out. So I've showed you that the benchmark is quite concentrated today. As a reminder, almost 50% of the FTSE World sits in that growth defensive bucket. Now, that's also impacting more investors than ever. We've touched on the fact that passive funds have become more popular. We've seen more money flowing into passives and out of actives. And I haven't even shown on this chart funds flowing into ETFs. So now that we've seen that the FTSE World Index has become quite concentrated in that bottom right-hand quadrant, and this is impacting a lot of investors, it might be natural to think, well, what might change? Or what has driven this? Why has the index become so concentrated in that bottom right-hand quadrant? Well, what we've seen since the end of the global financial crisis was an almost perfect environment for the stocks in that quadrant. They actually had relatively attractive starting valuations. We then saw limited fiscal stimulus from governments coming out of the GFC, which meant that economic growth was pretty low. Investors were therefore willing to pay up for the economic growth that they could get from these growth defensive companies. The combination of lower economic growth and lower interest rates also meant that central banks were able to keep interest rates at historically low levels, again, providing a bit of a tailwind for the companies in that quadrant. And then finally, the icing on the cake was 2020. As I said before, many of the lockdown beneficiaries are in that growth defensive quadrant, and their business models were almost perfectly suited to the environment we saw last year. So we've seen that the index is quite concentrated in that bottom right-hand quadrant. And as a result, the question might be, or the natural question might be, does it not make sense to try to diversify outside of that quadrant? But what we're actually seeing today, and what concerns us and what worries us, is that investors seem to be betting on the current status quo enduring and expecting that the winners of the recent past will continue to win in the future. So what are some signs of that? Well, firstly, the top 5 shares in the S&P 500 are more dominant today than they were in 2000. So we're seeing lots of concentration in the market. If you look at Microsoft, Apple, Amazon, Google, and Facebook, they represent 23% of the index. Now, we'll also acknowledge that we think those companies are great businesses. They have strong fundamentals, they're growing quickly, they have good management teams. They also don't trade at extreme valuations, and we found some value in that area. Facebook is one of our top holdings. But as I'll touch on later, the future is extremely hard to predict, and we don't know how things might change or what will change. And if things do change, we certainly don't know what impact it'll have on these companies. And as a result, does it really make sense to be so concentrated in such a small group of stocks? Another sign of You know, concentration is not the only sign we're seeing that investors think the current environment will continue. We've seen that aggregate valuations in the US have reached quite high levels, but if you dig a layer deeper, we're starting to see some extreme valuations. On this chart, and some pockets of speculation. On this chart, I've showed the number of stocks that trade above 10 times revenue. You can see that at the end of April 2021, almost 70 stocks traded above 10 times revenue. And that's 10 times revenue, not 10 times earnings. Now, if you're able to identify the next Amazon, 10 times revenue might be a bargain, but how many of these stocks can really go on to be the next Amazon? And we know from history that investing when a stock trades at above 10 times revenue is not usually a good starting point to generate stellar returns. Another sign of some of the speculation in the market is the amount of capital that's been raised. On this chart, we showed capital being raised through the traditional IPO route in blue and through SPACs, or special purpose acquisition vehicles, in red. Now, a SPAC is essentially a blank check company. A promoter raises cash with the promise to spend that cash on a really interesting company at some point in the future. These SPACs are being sold based on a story. Now, if you look at the period from 2003 to 2019, only $70 billion in total was raised in SPACs. That figure was exceeded in 2020. And in the first 4 months of 2021 alone has been exceeded again. And that's not surprising, given that we've seen celebrities like Jay-Z and Serena Williams endorsing these vehicles. And of course, I haven't even touched on some of the other signs of speculation that we've seen in the market, and have also been touched on by other co-panelists, the popularity around crypto, some of the retail investor trading activity, etc. So, as I said, we've seen this concentration in the market, and we've also seen signs that investors think the winners of the recent past will continue winning. But what might disrupt that? And before I give an overview of that, just importantly, this is not a prediction. We actually think forecasting the future is incredibly difficult, but just to give you an idea of what might change. So we've seen that the US has been sending out massive fiscal stimulus. People have literally been sending or receiving checks in the post. With vaccines, the end of lockdowns, pent-up demand, we might see higher economic growth in the future than we've seen in the recent past. We've also seen some signs of inflationary pressure emerging. Commodity prices are rising, house prices, wage pressure. If that continues, and if we see high inflation, central banks might have to intervene at some point and increase interest rates. We think that's more likely to be a headwind for stocks in that growth defensive quadrant rather than a tailwind. Now, importantly, as I said, that's not a prediction. We certainly wouldn't bet the farm on this outcome, but we also know from history that things can often change very quickly and in unpredictable ways. So does it really make sense to be so concentrated in that bottom right-hand quadrant? Now, we think the good news is that you don't need to be that concentrated. One way of finding value is to take an active, fundamental, bottom-up approach to look for stocks that are trading below intrinsic value, where there are different drivers of value and different drivers of growth that can help you build a resilient portfolio that's able to handle multiple outcomes in the future and is not too reliant on one outcome over another. And we think we've been able to do that in our global equity strategy today. If you look at our portfolio, you can see we have a nice even spread of stocks across all 4 quadrants. If you contrast that to the FTSE World Index, 7 of the 8 names actually sit in that bottom right-hand quadrant. And we've got an eclectic bunch of stocks, each of which have different drivers of value and growth. We've got a transportation and logistics company, a car maker, a health insurer. In fact, the only thing that they have in common is that they all trade at a discount to intrinsic value. Now, the one thing I would point out is that we have found some value in that bottom right-hand quadrant, but that's mostly in Asian technology names. They tend to trade at a discount to some of their US counterparts, despite growing more quickly and having comparable technology. So before I end it off, I just want to finish off with my key messages from today. So looking at the FTSE World Index, there does seem to be a lot of eggs in one basket. If you look at that growth defensive quadrant, 50% of the benchmark is sitting in that. And our question really is, does it make sense to be so concentrated in one part of the world? investors don't seem to think that, or investors certainly seem to think that the current market environment is likely to endure and haven't diversified. If you're a passive investor, it's been much harder to diversify. But we also think that a sudden shift could leave passive investors much more exposed. One way or one solution to this problem is building a portfolio from the bottom up, which can yield a resilient portfolio, which is not too dependent on one view of the future over another. So thanks very much for your time. I'm going to stop sharing my screen now, and so the next presenter can take over.
Thank you very much, Fiona. We all feel breathless about the prospects for value investing with you. Thank you very much for the presentation. I'm going to hand over to Luke from Goldman Sachs Asset Management on thematic investment. Thank you, Luke.
Thanks, Pierre. So guys, firstly, look, thank you so much for hearing me out today. What I wanted to present on was more of our long-term view around thematic investing. And a lot of this will parallel with what we've heard more recently in the last presentations just on growth investing. I think there are some commonalities, but ultimately what we're looking for here are companies that can really benefit from long-term demand tailwinds. And so in the next 10, 15 minutes, what I really want to cover off on is three things. One, we do fundamentally believe that thematic investing can better position portfolios for the future. We think there are 4 key megatrends that all investors should have exposure to. And these are 4 megatrends that are benefiting from structural improvements in demand. And then thirdly, despite the connotation that maybe thematic investing should be seen as more risky, we actually find that they can form a very attractive part of client portfolios. And actually in many cases, despite their connotation of being higher risk, can help to mitigate what are oftentimes unseen risks in portfolios. And actually the relationship between some of these thematic portfolios, the fact they actually tend to have quite low correlation, can be quite attractive within a broader portfolio solution. So I just want to start just really to set the scene here and make one statement, which is when we think about investing in equity markets, what is very critical to understand is that for any long-term investor, someone with more than a 5-year investment horizon, the #1 most critical factor that will drive success is corporate fundamentals. When we look at the returns for equity markets, more than 80% of long-term returns in equity markets come from underlying company earnings and dividends. So multiples are important, FX is important, we have to think about that in the context of shorter term dynamics, but ultimately when we think about the long-term success that we can have in equity markets, it's about finding companies that are well placed to capture that underlying growth. Now, looking at the slide we have here, what's quite interesting to observe is despite the fact that we're seeing some positive backdrop in terms of cyclical improvements globally, in terms of growth and economic activity, actually we're still at structurally low levels in terms of the scarcity of growth. So what we've shown here is just a breakdown of the global equity universe, showing companies that are in that high growth category, in other words, growing more than 8%, and then that low growth category, i.e. growing less than 4%. And you can see over much of the last 2.5 decades, we've seen a structural decline in the number of companies that can deliver meaningfully high growth. As I said, we've seen a little bit of a positive improvement in the last 6 months as economies have reopened, and we've seen some cyclical improvement, but on a forward-looking 3-year view, we're still at a point where only about 20 to 25% of companies can deliver in that high growth category. And actually low growth is actually far more common than it's been at many points through history. So today, even with the improvement we've seen in the last couple of quarters, we're still north of 40 to 45% of companies that are going to be unable to grow more than 4% over the coming 3 years. And actually for many of those, what we see is that companies are likely to grow in negative territory, likely to be meaningfully worse off than just that 4% growth hurdle. So going back to what I said a second ago, if we think that it's critical that investors are targeting companies that can deliver high growth, because that is what's going to drive positive corporate fundamentals, that's what's going to drive positive equity market performance over the longer term, then we have to be conscious that the world we're living in today is a far more challenged backdrop for growth than it has been at any point through history. Now, just thinking about then the implications of that for investors. I know there's a lot of discussion around the nearer term dynamics of how growth and value is likely to play out over the coming quarters, but if we think about it longer term, and we go back over the last 6 or 7 years, what is very apparent is that if you are on the right side of disruption, if you can find those companies that are benefiting from those long-term secular growth demand tailwinds, your portfolio will have done meaningfully better than if you were positioned on the wrong side of some of those trends. And so what we're looking at here is just some research we've done in the US, looking at what we've termed disruptors, or companies that are aligned to those secular growth themes, versus those that are on the wrong side of those disruptive trends. And you can see the magnitude of outperformance, almost 200% for those disruptors versus almost 100% underperformance for those that are misaligned to those growth themes. Now, just a couple of points to make here. It is not to say that in periods of rotation where inflation concerns or interest rate concerns come to the fore can't be a headwind to some of these growth stocks. You can see that in the latter part or mid part of 2018. You can see that in the early part of last year as COVID concerns picked up. But the reality is, if these are companies that are continuing to drive growth in earnings, that are continuing to deliver that value to underlying shareholders, then that is something that is incredibly valuable in a world where growth is increasingly scarce. And whilst we might see some short-term moves in share prices based on that discount rate mechanism that Jared mentioned earlier, I think the reality is that for a lot of these businesses, not least of which those that are more aligned to some of those technological advancements that are very capital light in their construct, that shouldn't be a meaningful headwind over the longer term. These are companies that continue to self-fund themselves. These are companies that continue to deliver on very high expectations around growth and demand, which should be very beneficial to your underlying investors as they think about capturing those long-term demand themes. So now just turning the discussion to where we see these opportunities arising from. And from Goldman Sachs Asset Management's perspective, we really see 4 critical megatrends driving the forward-looking investment landscape. 1, technological advancement. 2, the new age consumer. 3, the future of healthcare. And 4, the greater need for environmental sustainability. Now, we accept and recognize that these 4 themes are intertwined. There is a relationship that exists between each and all of those. And frankly, innovation in the technology space is helping to deliver advancement in all 4 of those megatrends. But we think there's also value in specifically targeting each of those areas and thinking about what's happening under the hood in each of those areas, because that can be very beneficial as you think about building an overall portfolio. So when we think about technological advancement, it's not just tech hardware advancements we've seen, it's also thinking about the digitalization of our day-to-day lives, what that means for Internet of Things and cloud-based software, what it means for the increased need of cybersecurity, but also digitalization of finance and payments that's all intertwined into that ecosystem. If we look in the US in particular at the moment, we talk a lot about infrastructure spending and the build out of the infrastructure requirements we see in the US. One of the critical parts of that is 5G infrastructure. And so when we think about the advancements in technology, it's not just about what are we seeing at the front end of that curve in terms of rapid innovation in some of these areas. It's also thinking about the supply chain and beneficiaries of that trend as you have to build out the relevant infrastructure to allow that technological advancement to come through. In terms of the new age consumer, I think a lot of you will have heard us talk about the millennial consumer. Over the last few years, we've been very passionate about this topic for the last now 6 or 7 years, really arguing that the younger generation, those individuals born after 1980, namely your millennials, are increasingly driving change in the consumer and retail space. That is a function of, 1, their comfort around digital technologies. So the shift we've seen towards the digital consumer landscape, away from traditional bricks and mortar retail towards e-commerce, but also in areas like experiences and health and wellness that your average younger generation tends to put greater value on. And so when we think about going back to that statement around wanting to be on the right side of disruption and growth, there are absolutely companies out there that trade very cheaply on an optical basis that are in the traditional retail space, that have bricks and mortar retail facilities, or real estate businesses that are aligned to some of those shopping malls or other retail spaces. But that is a very challenging place for us to get comfortable investing in on a forward 5 or 10-year view, just given the rapidly changing dynamics. And especially as we look at the emergence of a Gen Z consumer, i.e. your individuals born after 2000, the fact they have very common traits to what we see in that millennial demographic. As that cohort also gets wealthier and amplifies the disruption that we've already seen over the last few years, we think that's going to be a very interesting phenomenon for people to observe and very disruptive to your traditional retail business model. Thirdly, we have future of healthcare. And actually, I'll just jump to one slide that I think is interesting to talk about here, because the conversation around vaccine was brought up earlier. 2 of the vaccines that I think are very commonly referred to here are the Pfizer and Moderna vaccines. Now, the interesting nuance there is that they are developed using what's called messenger RNA technology. They are effectively using individual genome sequencing and understanding of that precision medicine approach to target specific outcomes in the individual. In other words, what they are doing is tricking your body into creating antibodies, as opposed to actually having to receive some of the pathogen to create those antibodies. Now, those are the first instances in history where we've had vaccines created, not just in a very short space of time as they were, but also created from that genomic technology. And the reason that's been possible is because you've seen a material collapse in the cost of sequencing the human genome. So just for reference, when we sequenced the first human genome roughly now 15, 20 years ago, that project took the best part of a decade plus, and it cost about $3 billion, right? The Human Genome Project, it allowed us to first sequence that human genome. We're now at a point where Illumina in the US and actually some other competitors in Europe are able to sequence the full human genome for under $1,000. So as you look at this cost curve on the left-hand side and you think about the collapsing cost of sequencing the human genome, what that is start to utilize that technology in many new instances and new ways within the healthcare space. Now, with the caveat that actually as of today, we've only had about 2 million people globally who've had their full human genome mapped. Now, as we go through the next 5 to 10 years, it's very likely that almost all individuals going into treatment for serious diseases will have their genome mapped. And as we get access to that data and we can better understand what it is that's happening in any individual, we are able to start to build more unique solutions to some of these major challenging diseases. So you can see on the right-hand side, something like oncology. With cancer, we have a success rate currently in that one-size-fits-all approach of only around 25%. It's very possible that as we get better understanding of some of the ways in which those cancers attack any individual, as we get better insight into the genomic aspects of that, we'll be able to get that success rate meaningfully closer to 100%. As you go through into some of the genetic diseases, there's unfortunately around 6,000 rare genetic diseases today. We only have a cure or treatment for about 5% of those. And so actually being able to utilize this new technology to really understand what it is that's happening in an individual's genomic sequence, understand how we can help solve for that, is really going to amplify the growth opportunity for companies in this space. And so when we look at healthcare as an industry and we think about big pharma and the one-size-fits-all approach that's been universal across that space over the last few decades, actually this could be extremely disruptive and really change the dynamics across that space in a very material fashion. Now, just then turning to just in terms of what we do, as we mentioned, we think that there's value in having exposure to each of these megatrends. The last one we mentioned here was environmental sustainability. That's really trying to identify companies that have unique solutions to environmental challenges, companies that can deliver some kind of positive product or solution that helps reduce our dependence on carbon assets, that helps to improve resource efficiency, helps to advance circular economy, or helps to improve issues around water scarcity. Now, what we've tried to do as a business is really offer our clients a range of different solutions. So we run strategies in the technology space. You can see our technology opportunity strategy and our future technology leader strategy. In the new age consumer space, our millennials equity strategy. In environmental equity space, we have an environmental impact product that specifically targets those solution providers to those core issues. And then in the healthcare space, running a future of healthcare strategy, where we really target specifically those companies engaged in genomic technologies and precision medicine. At this stage, we are in the process of rolling these out to South Africa. So our Millennials Equity Fund is available for retail distribution. We are working with some strategic partners to bring some of these other products to market in a multi-thematic format. And I think that leads us nicely into the final part of the conversation, which is then how do you build this into a portfolio? What are the considerations that you as an underlying investor need to think about when you're trying to capture some of these forward-looking secular growth themes? Well, first and foremost, I think there's a very easy way we consider doing this. We can think about just allocating some portion of our traditional core equity exposure, be that active or passive, into some of these thematic solutions. So building more of a core and satellite approach where we have a small but importantly sized piece of our portfolio that specifically targets those areas of disruption. If we go back to that picture we showed at the outset, where we see the relative outperformance of some of those companies aligned to these innovative and disruptive themes, that can be a very attractive way to build better security into your portfolio and better future-proof your portfolio if this is the direction of travel that we're going. But I think there's also another way we can think about this. And I made the statement that by nature of how these different themes interact with one another and how they evolve over time, that they can actually be put together into a solution that can have an attractive overall risk profile. What we see here on slide 16 is just that if we start to blend together the different thematic portfolios, we actually can produce something that has a relatively lower active risk than any of those individual funds in isolation. And I think that's an important statement, because as much as these are all portfolios that are levered into long-term growth dynamics, as much as these are portfolios that are really targeting innovation, they actually have very different risk profiles. So our environmental equity strategy would be more pro-cyclical in nature because it's a function of government and corporate capex. Our future consumer strategy would be in some ways more defensive because as well as accessing some of those new age growth-orientated consumer plays, you're also thinking about just the general consumer trends across that landscape as millennials and Gen Z consumer become more important. And similarly in the healthcare space, even though that has some higher volatility and active risk because you're really going away from big pharma and really targeting some of those innovative earlier stage companies, that can bring its own risk profile to the table. And so when you put those together and recognize the correlation between those different strategies is quite muted, actually what you can build is something that on an equal risk basis has a more appealing and attractive overall risk profile than any of the individual products would in isolation. So I'll just stop where I started, which is to say, we think that thematic investing is a critical part of all client portfolios. You have to take a long-term view, but if you can take that long-term view and position your portfolio for the future, then there is a very obvious way in which you can bed in some of those longer-term demand tailwinds. And focusing on those 4 mega trends that we mentioned, the technological advancement, new age consumer, future of healthcare, and environmental sustainability themes is a very appealing way in our minds of future-proofing portfolios and ensuring that you're on the right side of that disruption. And then building thematic solutions that embed each and all of those different solutions can actually form a very attractive part of client portfolios that allows you to not just take a core satellite approach, but actually allocate a meaningfully increased amount of your portfolio towards these thematic type portfolios in a way that doesn't necessarily meaningfully enhance the overall risk profile of the strategy. So I'll pause there. Pierre, I'll hand back to you and happy to take any questions if there are any at the end of the session.
Thank you very much, Luke. And thank you to all the speakers for the great presentations. We actually do have a couple of minutes before the end of the session, so I think I've received quite a number of interesting questions, and I've received some commentaries as well, which I think I'll keep for the breakaway room. But let me maybe put one to you, Luke, since you were last up. And the question was really with reference to some of the data you showed. The question is, is there not survivorship bias that are being ignored in these companies that are adopters of new technologies? And I suppose to broaden the question maybe a bit is to say, what in your process, exists that give you confidence that you find the companies in these interesting spaces that you've been speaking about that are going to be the winners and not the blowouts?
No, it's a very fair and important question. So 2 points. One, yeah, there is some survivorship bias, but I would say in that data, let's also recognize there's survivorship bias to the downside as well, right? In other words, when we think about those companies that have been disrupted and have actually ceased to exist, there are a long list of names that would no longer be in your investment universe that would have meaningfully negatively impacted portfolios because of the misalignment to some of those longer term themes. Now, in terms of how we think about it, look, we have to put ourselves on the right side of disruption. We have to position ourselves to capture that future growth. That doesn't mean we disregard our underlying investment principles. So we still have to make sure we trust the management team that we are investing with. We have to see there's a very clear path to profitability and cash flow generation for these businesses. I think far too often in the last few years, people are willing to invest in and fund businesses that have no reasonable path to being profitable or delivering value to minority shareholders. And there's a lot of hype embedded into the multiple you're being asked to pay. So just going back to those fundamental principles is a very crucial aspect of it. And I think we're fortunate because we're in a luxury position of having 80 investment professionals around the world. We have people across 6 different geographies. So as we're talking about parts of our universe in, say, China or Japan or India, where we have people on the ground that can give us real perspective on what's happening there, that can be incredibly valuable. And then, Pierre, I'll make one last comment, which is, don't always think that the most obvious way of playing a theme is the best way to play it. So there are often times where actually doing a little bit more work and thinking more about the overall value chain can be a much more appealing way of capturing that. So I'll just use the electric vehicle space as a good case in point here. Absolutely an unbelievably, phenomenally attractive story. We're looking at global auto penetration as it relates to EVs somewhere in the 4 or 5% range today. I think it's very realistic that could be 35 or 40% by the end of this decade. And actually in some markets like China, it's probably going to go north of 50% inside the next 10 years. Now, the challenge we see in that space is that actually building an electric vehicle is not particularly challenging. The engineering required for that is not that complex. And so what you're going to see is much greater competition in the auto manufacturing space as more and more of those traditional auto manufacturers bring to the table their own EV solutions. So price compression and just general increase in competition is going to be a challenge for those names. But actually, if you go down the supply chain, you think about some of the battery technology producers, if you think about some of the companies producing micromotors that are critical to those different EV producers, actually you can find a much more appealing way of accessing that story in a way that also embeds, it protects you from some of that competitive intensity in a way that maybe those auto manufacturers are not well placed to deliver against. So that's how I'd frame it. I think there's lots of nuances to it, but ultimately it just comes down to going back to your fundamental principles and not just ignoring the fact that because a company is aligned to a theme, it has to be a good investment. Pierre, you're on mute again.
On mute.
twice on one day. Thank you very much, Luke. Thank you to the other speakers. I will keep the list of questions. I've jotted them down and we'll take them up in the breakaway room. For some audience members like Mr. Fourie, I think it's going to be difficult to decide whether he's going to come and spar in the global equity breakaway room or the SA balance breakaway room. So good luck with the choices, but back to you, Eugene, and we'll see you in the breakaway room later.
Yeah, Pierre, thank you very much for that. We're on track and on time, so well done to this panel. That was a lengthy panel. So Pierre, Nick, Jared, Fiona, and Luke, well done. Thank you. Caution to passive investors. Sudden shifts may leave you breathless. Well, and well done, Fiona. On that point, you've managed to keep it remarkable pace. So not out of breath at all. So thank you so much. Right, here to introduce our last panel of the day and the conference, sadly so, on ESG investing is Victoria Rivers, Managing Director of the Morningstar South African Investment Management Group. She's responsible for leading the business and leveraging Morningstar's global investment capabilities to provide best practice investment management for clients in the form of both SA portfolio construction and global USD portfolios. Victoria, thank you so much for joining us. I know it's the last session of the day, but a very interesting topic, and I think something that you like as well. So off to you to introduce the panel. Thank you.
Thank you, Eugene, and good afternoon, ladies and gentlemen. Yes, the last panel of the day, and something ESG that is something that is very close to Morningstar's heart. So our panel today comprises of one portfolio manager, Catherine Davidson from Schroders, and then we have two local speakers, John Duncan from Old Mutual and Dion Janse van Rensburg from BCI. So as I mentioned at Morningstar, ESG is a core focus for us. It's actually part of our DNA, and our recent acquisition of Sustainalytics now means that we can provide advisors with not only market-leading fund research, but also ESG ratings and research. Today, globally, total investments with a focus on ESG principles are estimated at $30 trillion. That's 1 in every 3 investment dollars. And ESG principles have been adopted to some extent by 86% of companies on the S&P 500. So the pressure on companies to adopt these practices has increased by the likelihood of the new regulation becoming the new reality. Yet when you talk about ESG, it's still a very subjective topic, and there's a lot of confusion about what it really means. So first up on the agenda is John Duncan, who is the head of responsible investment at Old Mutual. John has over 24 years of professional experience in the field of sustainability research, 10 of those being with Old Mutual. And I do think it's worth mentioning that John was involved in drafting the South African Code of Responsible Investment, and he currently serves on the UN PRI Global Reporting and Assessment Committee. John's going to unpack the what, the why, and the how of ESG, and why you as an investor should care about it and how to implement it in your clients' solutions. So John, on that note, I'm going to hand over to you.
Thanks very much. I really appreciate the introduction, and thanks very much to the BCI team for hosting us. It's not the first time Old Mutual's been on this platform, and it feels like it's the first time we're speaking to the sustainability topic. And as you'll see, the way we're positioning it, we are positioning this from the perspective where we think it's a permanent long-term reorientation of capital. And it's a trend that is fundamentally reshaping the investment industry. And sort of, I think, builds quite nicely from the presentation that Luke just gave earlier. So I'm going to share my screen right now. Just want to make sure that's coming through okay. Are you able to see that?
Not yet, John.
Able to see it, yeah.
Give me 1 second. How about now?
It's loading up. Perfect.
Fantastic. Brilliant. So yeah, look, I've got 3 points that I really wanted to cover today. The first is sort of, I'm going to spend probably about 5 minutes on each, the what, the why, and the how of ESG. You know, what is it, why we think it should matter to people that are involved in the advisory industry, and then really how one could think about going about it for client solutions in the context of SA. I guess the starting point is we like to remind people that we only have one of these. This planet of ours is a closed system, not a great deal enters or leaves. It's a relatively complex system with a lot of interrelations between various aspects of it. So population growth driving urbanization, which can lead to water scarcity, which can drive ecosystem decline. So it's a complex, interconnected set of systems. And we think this sort of contextual view on economic growth is important. At the same time, we also recognize that there is interconnectivity between systems. So what happens in the economy has an impact on society and the biosphere. And we know that, you know, the biosphere fails, societies fail, the economies fail. So for those of us professionals who are operating in this sort of economic sphere, it's important that we start to recognize the interconnectivity with these other systems. I really like this framing that's used by, that takes the SDGs and splits them out into this interconnected set of systems. I think what's critical here is to recognize that externalities matter. So for example, you know, we're all concerned about long-term climate change risk. This is an unpriced externality in the market that is increasingly being priced. And, you know, the big question out there, is this a risk appropriately captured inside of current portfolio positioning? I mean, another good example of a biophysical system risk, one that we've all recently been through, COVID is exactly that. What's interesting for me is that we can have a proxy measure of how exposed we are to this risk by just simply looking at the scale of financial stimulus that has been put into the global economy to respond to this biophysical system risk. So this idea of interconnectivity of systems is one of the founding sort of, I guess, underpinning thoughts when we think about long-term shifting of the capitalist system. Probably some of the sharpest thinking that I've seen around this topic is written by Michael Porter and Mark Kramer out of Harvard Business School. They wrote their sort of famous piece on shared value. It's this idea, I mean, those of you who've studied an MBA will know Porter's 5 forces of competitive advantage. It is, you know, he did some really hard thinking on that in the early 2000s and really just said, look, given how volatile society and the environmental systems are, the best profit mode, profit strategy that one can employ is one where you are solving for not only long-term financial outcomes, but also solving for long-term systemic and social risks. And so this idea and this thinking around how do we repurpose and refocus capitalism very much sits at the heart of our kind of systemic view of the shift that the capital markets are undergoing. And our view is that the sustainability theme is not something that is just unique to, for example, you know, active equity or say passive equity. It's equally as relevant for fixed income as it is for private equity and infrastructure. And the opportunities to play these themes obviously looks and feels very different depending on your risk appetite, your asset class, and the investment opportunity set available to you. I think what underpins all of this, which is consistently true, is this idea that the business case or the sustainable investment thesis still holds true. So this idea that, you know, sustainability is a macro thematic trend, it is fundamentally reshaping competitiveness across all industries globally. And we think companies that are getting ahead of this topic relative to their peers who are not will show a number of important and observable attributes, such as lower cost of capital, better resource efficiency, and the like. You can see them here. And on a long-term basis, we believe companies with these characteristics will outperform their peers. Obviously, ESG data provides us with an insight into some of this. Mark, the earlier speaker mentioned themes. Obviously, you know, the way we see that is we question whether a company produces its revenue through a good or a service that's aligned with long-term sustainability or green economy outcomes. And sort of having visibility of that and bringing it into an investment process sits at the heart of our approach to responsible investing. So organizationally, Old Mutual, we've been on this journey for the last decade. You know, there's a handful of investment professionals with sustainability backgrounds that sit inside of our business. I look after a team of 5 purely looking at the listed equity space. And our thinking here is that it's not just about retrofitting this ESG lens into your pre-existing process. It's actually about fundamentally capturing the upside that the insights give you into products that are designed to outperform. So we don't think that this is a question of return sacrifice. So why do we think it should matter to you? I mean, at a big level, we think that the sustainability investment thesis is playing out. And this is slightly outdated now from Morgan Stanley, looking at sort of peer relative performance strategies over time. So for the period 2015 to 2020, you can see socially responsible, sustainability related investments, slightly outperforming their peers, but underperforming the benchmark. And then that's slowly starting to tilt in a more positive direction over time. And certainly our analysis shows that this, this performance tilt continues to hold true in time. Through our own experience, we run a range of ESG index strategies for South African institutional and retail investors. Here you can see, we run a whole range of index products. This is the MSCI ESG index relative to the MSCI EM index over time. Some tracking error, but an outperformance signal that we think would be, it's pretty hard to beat that with active management at this point, as far as we can see. And so, a handsome set of returns and a strong signal to us that, if applied correctly, capturing this theme is indeed possible. So first point, why should it matter to you? Well, we think there's a performance signature here that allows you to get both appropriate risk-adjusted returns, as well as getting a good sort of ESG story baked into the product. So performance matters. At the same time, we also see growing investor appetite. We heard earlier that from Victoria that $1 in 3 globally is going towards strategies of this nature. Our own testing recently across the South African market, and we've been doing this for a number of years, is showing increasing appetite for consumers to orientate themselves towards products and services that have sustainability attributes. And we see that in the investment sector with increasing flows over time into products that have sustainability attributes. I will just, however, give a health warning here, simply to say that because a fund is labeled sustainable or has ESG or green economy baked into it, doesn't automatically mean it's going to produce outperformance. So just a quick health warning. Lastly, we think that, from an overall sort of advisor business enterprise perspective, we think this is a topic that we believe having some literacy on will help you retain your existing clients. We see growing interest from our end clients to understand sustainability risks in their existing portfolios. We also see it as a fantastic opportunity to attract new potential clients, as well as we think it's a sustainable way to diversify and grow your clients' assets over time. Just in the attracting new clients, everyone knows that millennials are digital natives. We understand this concept, but millennials are also sustainability natives. And so this idea of intergenerational wealth transfer is an important thing. We would argue that the upcoming generation of inheritors of wealth will have sustainability thinking baked into the way they see the world. And so to have products that are suited to their needs, that produce appropriate returns, is really the key opportunity. So having some literacy on this topic as an advisor, we think is critical. I mean, how do you go about implementing client-focused solutions? My sense is that trust is low in the investment industry. Building trust with clients is critical. And we think aligning on values and beliefs around sustainability issues is a core way to build trust with clients. So we think there's big value in actually understanding what your clients' needs and expectations around ESG issues. I mean, you can sit on your hands and wait for them to bring the conversation to you, or you can proactively engage them to ask them, what are their beliefs and views on these issues? What do they think about gender diversity? What do they think about long-run climate risk? What do they think about income inequality, and how their capital is being used to either be part of solving for or fixing some of these longer-run issues while achieving returns? So, opening up space for that conversation, we think is key. I mean, obviously, as a minimum, appointed managers should practice responsible investment processes. And so that's I think there's no investment manager that's going to say they're not doing that. However, we do think that there currently in the SA market is a small but growing group of products out there that actually are designed intentionally to capture mandated ESG outcomes or upside opportunities. So, you know, how do you have a conversation like this with your clients? Our sense is, and so we've given a couple of talking points here, which we think might be helpful. We think that, you know, it's useful to understand your client's appetite. What are their beliefs? What do they spend their money on in terms of holidays, clothing, food? How do these themes show up in their own houses? Do they recycle? Have they got solar panels? What about water-related issues? You know, try to understand, take the level into the realm of personal values. One of my earlier slides sort of pointed out that, you know, sustainability is both the science of complex systems, but it's also the science of ethics and norms. And we shouldn't forget that. So we should create space for people to express their views. And then I think just to be very clear that this is not about compromising portfolio returns. It's entirely possible to seek alignment, both in terms of returns and values and long-term sustainability outcomes. So just sort of guiding that towards, you know, actual dedicated product solutions. I mean, first, let me just say that in the context of South Africa in particular, if we look at the green economy opportunity set, the bulk of the real opportunities for green economic growth typically sit in the unlisted market space. Having said that, we also think there is there's opportunity to manage downside ESG risk in the listed space. Globally, however, and in emerging market environments, we think there's a host of opportunities to actively play the sustainability theme. And so this sort of, I guess, guided slide here just sort of talks through space where, you know, we would point towards product that exists today that allows your clients to achieve, you know, certain kinds of outcomes. So, you know, there are many folks out there that, you know, see ESG or sustainability issues as financially relevant, but they don't want to take benchmark risk. What you can see up there is we've got a range of different solutions available. These ESG themed indices, they capture both, you know, the passive theme as well as the low cost theme, as well as a very interesting sort of return profile from an ESG perspective. We've got dedicated funds from an SA ESG perspective. And then, you know, moving down in terms of client preferences, we have products that are sort of more faith-based in the Al Baraka environment, as well as some of our balanced products. And I refer specifically to Age 28, where we've got a big wedge of capital aligned in that, in the alternatives environments in our schools and alternatives, infrastructure, renewable energy, and farming type funds. So we do think that there is space for product in this environment in South Africa, and we do see that opportunity set growing, going out into the future. So I'm going to end it there and just say thanks very much for hosting me. You know, wonderful to be in this panel on sustainability. I'm wagering a guess here that you know, the ESG conversation is going to shift from one being a dedicated panel to something that's just simply integrated into all panels going forward. Thanks very much. Back to you, Victoria. Well, let me hand right over to Catherine, sorry.
Yeah, thank you, John. I am going to give Catherine a quick intro, but I do have to agree with you that I think ESG is not going to, in the future, be something that is separate, but is that it is part of any conversation regarding investments. So, Catherine, before handing over to you, I just would like to introduce you to this the audience today. Our next speaker joins us from the UK. Catherine Davidson is a portfolio manager and global sector specialist with Schroders. Catherine has spent her whole career at Schroders, joining them in 2008. And there is often a view that exists that the interests of shareholders and stakeholders are different, and there's a permanent tug of war between the two. So today, Catherine is going to unpack how stakeholder capitalism can work for shareholders in the long run. Catherine, over to you.
Thank you very much. It's a pleasure to be with you here today. It's not quite as glamorous as being with you in South Africa, but maybe next year. This is certainly the more sustainable option anyway. I must say it's a little intimidating to follow someone of John's caliber, but actually he's set me up really nicely to pitch the fund, fitting into one of those categories that he showed at the end. So as Victoria said, I am Catherine Davidson. I'm the lead portfolio manager of our flagship sustainable strategy here at Schroders, the Global Sustainable Growth Fund, which has AUM of around $2.5 billion and growing fast. And what I'm kind of hoping to do is take where John left off and sort of zoom in on how we think about sustainability as active equity managers, what our sort of conception of it is and why you don't need to compromise returns for positive impact, and then how we go about finding those kind of companies without falling foul of the dreaded greenwashing. So let me try and share screen. I am not a digital, well, I am a millennial, but I'm not a digital native, so hopefully that's worked. Yeah, okay, good. All right, we kick off. So I'm going to start by not being able to change my slides, that's what. I'm going to start by defining my terms, because as we heard in the intro, everyone is now sustainable or ESG, and everyone is meaning something slightly different by that terminology. So just be very clear up front. And the way we approach this is as investors first and foremost. So as investors, we're looking for quality companies with strong growth and return credentials that will crucially remain that way over a long-term investment time horizon. So for us, sustainability is really about the durability of a business over that time. It's what makes a great company stay great. And for us, that really comes down to two key things. Firstly, it's companies that are run for the long term with management teams that are incentivized to think about multiple years of return and their successes, etc., rather than next quarter's earnings. And secondly, it's companies that take account of their wider stakeholders, so not just their shareholders. And this is now a much more familiar concept, but we strongly believe that companies do not operate in a vacuum, and that by approaching sustainability in this way, it's mutually beneficial for both shareholders and stakeholders, because companies with these credentials will be more durable in a rapidly changing investment environment. So just to pick up on the theme of the change in capitalism, so as I said, this is becoming mainstream, but not so long ago, when we sort of earlier into the life of the fund, I would have had to spell out exactly what I meant by stakeholders, those parties that have an interest in the future success of a company and which the company impacts with its behaviors. But nowadays, this is a very well understood concept, and the sort of stakeholder capitalism buzzword has become increasingly popular in the last couple of years. So I think we can say that 2019 was probably the year of E in the markets. We had Greta Thunberg and Extinction Rebellion and David Attenborough and Ocean Plastics, etc. But then 2020 was really the year of S. And I think that's marked a big shift in the way that people think about their investments as well. So we saw all through COVID that the incident really highlighted the social contract that's implicit between companies and the societies they operate in. So the media here in the UK, at least, was full of saints and sinners in terms of how they treated their employees or their customers, especially in the early days of the crisis. And now we're sort of talking about quid pro quos from companies that had bailouts last year, and whether they're going to pay those back or whether they need to sort of change their operating procedures permanently as a result. And the two charts on this slide just show how the sort of dialogue has changed a bit with investors and the general public. So the left-hand side is a snapshot from our institutional investor study, where we ask investors what are the most important topics that we should be engaging with companies on. And climate change and environment always come first, and they're still up there. But what we saw last year was a big uptick in awareness of social issues like supply chains, labour and human rights, employee rights, etc. And you can see the same among wider public consciousness on the right-hand side, where this is a Just Capital survey of the American public, showing that their perception that companies should be focusing more on other stakeholders and less on shareholders. So crucially, workers getting more airtime here. So what does that mean for investors? It sounds like pretty bad news if the focus is coming off shareholders and onto other stakeholders. And indeed, during COVID, we saw a lot of instances where companies cut their dividend in order to protect their other stakeholders. But we don't think that this spells doom for investors. And in fact, that's because we believe in this symbiotic relationship between shareholders and other stakeholders. And I tend to capture it as a kind of corporate karma is the terminology I like. So the way a company acts with regard to its stakeholders will ultimately have an impact on the company and its owners, us as shareholders. So we can visualize this as a sort of simple example with the relationship with employees. So the impact a company has on its employees via its salary and benefits packages, how well it takes care of its employees, its training, its workforce diversity, etc., will in turn have an impact on that company over time. So a company could maximize its short-term profits by exploiting or ignoring those stakeholders. So by paying the bare minimum, for example, or underinvesting in human capital development. But ultimately, that will have implications for the financials. It raises the operating costs associated with employee turnover, increased risks of strikes or disruptions, and ultimately the reputation of the company and its ability to attract and retain the best talent, which is what makes companies sort of future-proof and durable over time. So ultimately, that is in the best impacts of shareholders, even if it comes at the expense of slightly lower upfront earnings. And happily for us, there's an alpha opportunity here because markets, while everyone says they care about ESG and everyone says they're doing it, markets are still profoundly poor at pricing these kind of non-financial factors, which is why we've seen the continued outperformance of ESG funds. So in my fund, we've seen consistent compounding returns from stocks that we've owned for maybe 5 years plus, those stocks that can really beat the fade because the market underestimates the strength that the corporate relationship, that the stakeholder relationships give to the business. They're also much less likely to experience drawdown risk. So we've had a very strong information ratio as well. So that all sounds very conceptual. So let me try and bring it to life with an example. I'm afraid it's a UK company. And one that there actually no UK investors will have heard of either, so you won't be disadvantaged there. But Spirax Sarco is a niche UK mid-cap steam engineering company. So very esoteric, and it's a great business for a start. So it's a business that we'd known at Schroders as fundamental investors for a long time. It's grown its dividend every year for over 50 years, including a 7% increase last year in COVID. And it's delivered high single-digit organic growth since the 1980s. So there aren't many of these around. And when we were sort of looking at it, we were thinking, this clearly isn't about one management team. There's been changes in the company over time. So what is the secret sauce here? And it really comes down, when you do the analysis, to their employee relationships and that human capital management that I talked about on the previous slide. So Spirax relies on engineers to generate its sales. So nobody really knows they need a steam system. So they rely on the engineer going out to the client and doing sort of factory floor walks and saying, did you know you could save this much water, this much energy, recycle the sort of heat use in your plant, for example. And that relies on very well-trained and experienced employees. But the challenge for Spirax is that the UK is really bad at producing STEM graduates. So they've dealt with this by setting up their own university, the Spirax Academy, that takes new graduates and trains them up. They spend more than all of their competitors in the industry combined on training, which results in higher productivity. And you say to them, well, don't you just experience, don't your competitors just poach your staff after you spend all that money? But the culture there is so it's so pleasant and so amiable that their staff retention is very high. They pay very decent wages, and when employees are poached, they often end up coming back a few years later. And this has, on occasion, come at the expense of short-term profit. So the company has chosen actively to reinvest, for example, the Brexit windfall from the currency change into the Spirax Academy rather than return it to shareholders. But over the long term, it has enabled this business to compound. So that's one such example. I just wanted to provide a sort of bit of proof of concept on that sort of thesis that there is no trade-off between returns and sort of shareholders and stakeholders, return and non-financial impact. So this is just a snapshot of the fund performance over the last few years on the left-hand side. And the outperformance, it's worth saying, has been driven overwhelmingly by stock selection. So it's not been a function of sector or style or geographic biases. It's been around finding those really core compounding companies and holding them for the long term. And on the right-hand side, you can see this is from one of our internal tools, SustainX, which is far too complicated to try and explain in the remaining 4 minutes and 24 seconds, but please join the breakout later. And this is just a tool that aims to capture the wider societal impact that companies have beyond their profits. And you can see here that the fund has a significant positive impact, less harm and higher benefits to society than the benchmark. So this is sort of proving out that so far, at least, there has not been any trade-off between those interest groups. So just to finish off with, how do we go about finding these companies, the likes of Spirax? Because it's actually easier to say, what do we not do? And we are very wary of third-party scoring systems. There's a huge amount of valuable information provided by the likes of MSCI, but I would say be very cautious about funds that use them as a sort of screen or the entire underpinning of their investment strategy. They tend to reward disclosure much more than actual commitment. So an MSCI score, for example, has around twice as many metrics for policies or programs than it does for outcomes. And that ends up rewarding companies domiciled in places where they have a legal requirement to disclose a lot, and also larger companies that have more resource to throw at their CSR reporting. They're also backward looking by their very nature, and they're very inconsistent between the different providers. So there's a sort of joke that, how do you get a better ESG rating? Go and ask somebody different for a score. And that's not because any of these ratings agencies are individually wrong. It's just because what you're trying to do is very, very subjective and nuanced. So it's unsurprising that you don't see a strong correlation between the outcomes. And I'm not sure whether this quote is officially Einstein, but it's attributed to him. So I believe very strongly that not everything that counts can be counted, and not everything that can be counted counts. So trying to capture all your ESG analysis in a simple score or grade is sort of giving a sense of false precision to a very complex topic. And as John mentioned, your clients will have different views on what they want to prioritize, how their personal ethics dictate that they want to allocate their money. And that has to be taken into consideration in a more sophisticated framework. So I'll just touch on this briefly, given we're running short of time, but what we've put in place for this fund is a proprietary framework, a qualitative framework for assessing sustainability. So we wanted to bring the discipline that we have on the fundamental investing side to our sustainability analysis. The value add really comes from our in-depth research on the companies, the discussion and debate between our diverse teams, and about how holding companies to a high bar. We use all of the available sources, including almost always engaging directly with the company. That way you can help avoid greenwashing, and you can also avoid penalizing companies just because they don't disclose that much. We have a very high bar for inclusion in this strategy. It's a concentrated fund that is only looking for really best-in-class companies. So we reject over half of the candidates that we look at. And the other nice thing about this setup is it's fully dynamic and forward-looking, because it's not just relying on published data points. I am not going to have time to give my full pitch, so please join the breakout afterwards for any further questions, and I look forward to telling you more about the fund. And I believe I'm handing over to Deanne. Or not? Am I handing back to Victoria?
Yes, good afternoon. Should be able to see my screen now?
Yes, we can, Leon.
Yeah. So good afternoon, everyone. So many investors are still skeptical about ESG investing, especially in South Africa. The question is always, will I make money, or am I only doing this to feel good? So ESG investing is not driven by ethical values or feel-good factor anymore. It's all about financial returns and risk. As with any investment, the risk versus return should be considered when analyzing a stock. and ESG is a useful tool in that analysis. Green industries can achieve a higher return due to technological developments, consumer preference, as well as high demand. Whereas for carbon-intensive industries, there's higher risk in those industries due to higher cost, tax, regulations, and stranded assets. And we'll explore these risks in the following slides. So here's a slide that illustrates the cost of electricity over time, and the cost of renewables decrease as the capacity increase. This is not the same for nuclear and coal. As capacity increase for nuclear and coal, the cost of those type of energy sources actually increase, or for coal it stayed the same. But the cost of electricity from renewable sectors are now much cheaper than that of coal and nuclear. So it makes sense to move away from the fossil fuels to more with solar and wind. And also the demand for coal has decreased. Coal power in the US has reduced from about 40% in 2014 to only about 20% in 2020. In the UK, they reduced their reliance on coal from about 30% in 2014 to less than 4% in 2020. And their reliance on oil for electricity also reduced in recent times. Additional risk for the industry is ESG regulations. There's been exponential growth in these type of regulations across the world. In 1997, there were hardly any climate laws in the world, and now almost every country in the world has a climate law. So that's additional financial burden and risk for companies. There's also the additional cost of carbon tax for companies. And currently there are more than 1,800 ongoing climate litigations in the world, including 4 in South Africa. So this illustrates the uncertainty and risk for carbon-intensive industries. It's not about only the E in that ESG equation. It's also about the social, the impact on society, as well as corporate governance. And we've seen some of those examples in South Africa, where companies failed on the S and the G. And if your companies don't treat their customers fairly, they will lose market share over the long term. Additional risk is stranded assets. This chart is from a Carbon Underground 200 report. And according to them, the potential emissions from fossil fuels is about 500 gigatons of carbon dioxide. To achieve that target of only 1.5 degrees increase in global temperatures by the year 2050, the carbon budget is only 80 gigatons. But even if 50% of this target is achieved, there's a significant amount of fossil fuels that will be stranded. As mentioned in previous slides, many countries are already reducing their reliance on coal for electricity, and therefore fossil fuels might be stranded earlier than expected. Definitive did this study on the auto sector and divided companies according to their sustainable value ratio to see are they ready for the transition opportunity or risk in the future. And they rank these companies according to the highest score, so they are the sustainable value leaders, contenders that's doing better than average, and women defendants and laggards. And as you can see, those in the sustainable value leaders category outperform the market by a significant margin, and they call it the sustainability premium. And Tesla is, for example, in that category, but there's also the more traditional automakers that is within that category or within contenders, and they outperform the other automakers within the defenders and laggards category. And many industries can be divided in these different categories. And those companies that adopted more sustainable business practice will outperform companies that don't transform their business practice. And performance doesn't have to be sacrificed. This chart illustrates the performance of the oil and gas sector, and during the last 15 years, that sector delivered 0 returns, whereas the Environmental Opportunities Index outperformed the Global All Cap Index. John also mentioned that the Old Mutual Emerging Markets Fund tracks the MSCI Emerging Market Leaders Index, and that index also outperformed the more normal market cap as well as active fund managers over the long term. And there's many other studies that support that ESG funds or stocks with a better ESG rating outperform those stocks with a low ESG rating. But there are many ESG investment opportunities in the global market, but locally they are limited. Pension funds are required to incorporate ESG into their investment mandate, according to Reg 28, but high conviction ESG portfolios are limited in South Africa. And therefore, we decided to launch a locally managed ESG equity fund earlier this year. So there's different types of ESG mandates. It initially started with norms-based exclusion. So that's a minimum standard companies need to adhere to be seen as a norms-based exclusion to make it. But it was followed by ESG screening, both negative and positive, and I'll get to that in more detail. And over time, it developed into ESG integration into the investment process, ESG engagement, and then the profit with purpose, that's for sustainable themed or impact investing. But unfortunately, in South Africa, many of those opportunities, the last two blocks, are mostly unlisted in South Africa, and it's only accessible by life portfolios like John mentioned. So we decided to launch a passive fund, which mostly focus on negative and positive screening. So negative screening is we exclude certain stocks based on a specific criteria, whereas positive screening is where you select the best performing ESG stocks within a sector. We also partnered with 2 NGOs to assist us with the ESG engagement part. As can be seen at the bottom, all these ESG categories achieved tremendous growth over the recent years. So it's one of the fastest growing sectors or mandates in the world. And the only one that did lose some assets were norms-based investing or screening. But like I said, that's just the basic standard for companies. The standards has been raised over the years, and that's why most of the growth is at the later end of the curve. So as illustrated in the previous slide, there's been a tremendous growth in ESG investing. It's a mega trend that cannot be ignored. A 2020 study by the US SIF found that 1 out of 3 US dollars are invested in sustainable mandates. That's about $17 trillion, which is a significant amount. So this slide indicates the exponential growth in global ESG ETF funds across the world. So we decided to launch an ESG index fund, and we selected S&P as the index provider due to their 20-year history within this ESG investing. They launched the first sustainability index way back in 1999, and over the years, they continued to launch new indices in a range. They've experienced and the resources to create the ESG index, and Core Shares in South Africa is responsible to manage this fund and track the S&P SA ESG index. So for an index fund, information is crucial, especially for an ESG mandate. The S&P uses both private and public information to score companies. They use companies such as RepRisk that use advanced machine learning to identify ESG risk in more than 100,000 companies across the world. S&P also recently acquired RubicaSam to improve their ESG ratings and benchmarking business. So information is crucial, and we look both at private information as well as public information. As mentioned in the previous slide, ESG index requires quality information. S&P based their ESG scores on 600 to 1,000 data points and 80 to 120 question scores. Therefore, there's a solid base from which they can score companies on ESG. So this slide illustrates the ESG index process. It starts by excluding certain stocks, or SP excludes certain stocks within the tobacco industry, controversial weapons, companies with more than 5% exposure to thermal coal, as well as the lowest 25 scoring ESG stocks in the global environment. Then we go into each sector and then sort the stocks by ranging them from a best score ESG to a lowest score ESG, and then target to only include the top 75 scoring ESG stocks within each sector. And then we'll weight those companies by float adjusted market cap. And like I mentioned, Core Shares then implements this index for us. So after that whole process, the sector exposure is similar to the parent index. So there will be some tracking error with the parent index, but at sector level, the exposure remains roughly the same between the ESG index versus parent index, but you're getting a much better ESG score out of the ESG index. There are some notable exclusions. Some companies are excluded due to their thermal coal exposure. And like I said, there's a big risk that those assets will be stranded in the long term. There are some stocks that was the bottom 25% in the sector, and that's why they are excluded. But there's one additional exclusion in our fund that S&P didn't exclude, and that's Sasol, and that's due to their high carbon emissions. And the reason why we excluded Sasol is that because it improves the carbon emissions of the index or the fund quite materially. It really reduces the carbon footprint between 22% and 33%, depending on the metric used, and improves the fossil fuel reserve emissions by 100%. So in closing, ESG framework means that you future-proofing your portfolio. Investors in the rest of the world has already made that shift towards ESG integration. SA investors remain skeptical, but hopefully my presentation today highlighted some of the risk of not incorporating ESG and rather the return opportunities from sustainable investments. ESG is a mega trend that one cannot ignore, and those companies within the defenders and laggards categories will cease to exist in the future, and it's also applicable to our financial services industry. Thank you very much. I'll hand it over back to Vicky. Thanks.
Thank you, Dion, and apologies about the intro there. I was actually very happy to listen to your presentation, because one of the things we've seen in South Africa is that while globally ESG has been a trend that's not only become well adopted and gathered flows, that hasn't been the case in SA. So it is going to be interesting to see how your fund is both well received and the uptake both in the strategy and in terms of flows. So panelists, we have got a few minutes for questions, and one of the questions I'd like to start with, John, in one of your slides, you showed flows into ESG funds, and that was well dominated by flows into European ESG focused funds, with the US attracting little flows. Obviously, a lot of that is a function of the Trump government that was in place. Do you think that that is likely to change going forward?
Look, our view is that the capital is permanently transitioning into investment vehicles that are aligned with sustainability outcomes. And so we do believe that is a trend that will continue. I mean, we've been offering ESG products in the SA market to the institutional space for the last 6 years. We've gathered over 30 billion rands worth of assets. So we believe there is a demand both for in the institutional space as well as in the retail space. Look, admittedly, the South African retail space has been slow to respond, but I do believe that is shifting. So yeah, in short, we believe that the continual transition of capital into products that are aligned with sustainability outcomes is a theme that is still got a long way yet to move. Okay, it's interesting to you say institutional has gathered a lot of assets. That is something that hasn't transitioned to retail yet in SA. When it comes to South African investors, there's been this conundrum of performance versus doing the investing sensibly and sustainably. And we know that if you just look at our broad market, and Dion showed some of this, the shares that are excluded, it is quite difficult between the banks, the miners, the oil and tobacco companies to be a sustainable investor. What would you say in terms of globally, a lot of the tech companies have actually been in most of the ESG portfolios, and Catherine, maybe you can answer this. And that's obviously been a sector that's done well. So globally, ESG funds have also delivered performance. How much greenwashing do you think exists in those funds? Do you think that will change if and when the cycle changes for the current investments?
Yeah, interesting question. And you're right to say that a lot of the global, especially the sort of more passive ESG funds, have been very heavily weighted in tech, because tech tends to look fine on all the sort of usual bad things. So it doesn't have high carbon emissions, for example, and or other sort of egregious failings. And the issues that tech does have are too complicated and too nuanced and not very measurable. So they're not don't tend to be captured in the sort of scoring systems that people use. So it's certainly been a contributor to the positive performance of a lot of the ESG space globally. I do think we are seeing a sort of a challenge to that market leadership more generally, as I think some of your speakers in your global equities panel talked about, and that maybe that might lead to more investors challenging the heavy overweight of tech and ESG funds, where I think largely people have been prepared to look past that due to the performance, but maybe now this is when we start to invite greater scrutiny. And it's certainly something that we've been having a lot more debates about internally about, you know, there is a difference between tech companies. I think it's unfair to lump them all in together, but looking for those that have really sort of understood their social responsibility and put in practice the best controls and procedures around customer data protection, for example, as well as sort of leading on the environmental side. Whereas there are, you know, other big tech companies, Amazon would be a notable example, that we don't think are really investable in sustainable funds.
Very interesting, a debate I'm hoping we can continue in the breakaway room. So we are out of time, and in closing, I would like to firstly thank you to the speakers on the panel today. Thank you for your time and thank you for your insights. To all the individuals on the call, I would like to challenge the belief, particularly in SA, that ESG doesn't matter. I think in a world we live in of recent corruption, state capture, corporate failure, and general malaise in SA, I believe the concept of sustainability has actually never been more relevant. So as our speakers have highlighted today, sustainability means good business practice, it means good governance, it means operating in a manner which ensures environmental, cultural, and community sustainability, which ultimately leads to positive outcomes for investors. So I think the days of believing that ESG doesn't matter are over, because a good investment is a sustainable investment. And on that note, I hope to see you all in the breakaway rooms for the different sessions. And thank you to BCI for giving us this opportunity to hear 3 fantastic days of speakers.
On that, Victoria, thank you so much. I think you've absolutely nailed it. You can still do the right thing, and while you still make money, you know, especially in the world that we live in at the moment. So it's a very good topic, and I'm sure a lot of clients out there are also asking for ESG funds. Right, with that said, we come into the close of our conference, but just before we all go, just allow me for 3 or 4 minutes just to close off with a couple of remarks. Which breakaway room to choose? You know, it's always difficult. I think we've got a couple of really good panels here today. But just a reminder to our audience, you can move between the breakaway rooms. So once you're in a breakaway room, all the links will be posted again in the chat box. So if you are in one for 10 or 20 minutes, you want to move to the next one, you are more than welcome to do so. But allow me to roll with a couple of well-deserved credits. To all our 42 speakers and presenters, your content was absolutely outstanding. And thank you so much for the contribution and making this an extremely informative conference. To all our sponsors that made a lot of this possible, you know, we can't do it without you. The sponsor page looks terrific as well. To all audience, you are more than welcome to go look at the sponsor page at the BCI conference website. Under sponsors, you will see them all there. To Dan and Avi from the Excel Academy, you've worked magic. This conference is absolutely smooth. You've done it this year again, like you've done last year. Thank you so much for everything you do for us. It was an absolute pleasure working with you. And to all our other technical hosts, we never see you. We can see it on the chat rooms, but our audience can't see you, for running the breakaway rooms. Also done a superb job, so well done. Everything ran smooth there as well. We'll see this afternoon. To Marcel and Colleen from Sideways 10 Up, handling all the RSVPs and registrations, and they will also be handling the CPD certificates. Thank you so much for that. We will sending our CPD certificates out within the next couple of days, so keep watching your email. We'll get it through to you. To the EFT marketing team and compliance and everyone involved, checking all the presentations, making sure everything is fine, getting the imagery right. The quality was really, really outstanding this year, so thank you for all your support there. And a very big special thanks to Tanya and your team. You've done an absolutely phenomenal task. It's been a couple of months of arranging this, a lot of hard work at the back. Very few people know about it, but you pulled it off again. Once again, an absolutely great conference. So thank you for that. And a big thanks to Bruce Whitfield and our DFMs for keeping conversation going throughout the sessions. We really appreciate it. And last, to everyone that dialed into, our audience members, thank you so much for attending. We hope you've enjoyed the conference and that you find the content or found the content valuable in assisting you with making decisions for your clients or assisting your clients. And hopefully by next May 2022, we can all see you in face at the Speed Conference, or perhaps a combination of the two, virtual or digital, as well as face-to-face. Time will tell. We're most certainly aiming for that. And just a reminder to everybody that all our conference content will be uploaded on the conference webpage, bciglobalconference.com 2021. You'll find all the recordings there. We'll probably upload it in the next day or two. We will also upload the recordings on Asset TV in June. So if you want to, you can go re-watch some of the recordings and sessions that you maybe missed or want to recap or rehash. May I ask that you all complete the conference survey. It's also on the conference website, please. This will help us to better understand where we can improve, what your needs are, and what your preferences are, and what you would like to see more or less of going forward. So please help us with that so that we can help you. And then lastly, Mr. Walton, last year I said, the expense account is going to roll over to 2021. Here we are again, and I'm sure our chief financial officer will argue with me, but my understanding is that expense accounts just keep on rolling over, even if you don't use it, right? We'll see about that. To everybody out there, it's absolutely been my privilege to host this world-class conference. And keep well, keep safe. Please link in to the breakaway rooms. I think it's going to be some very interesting conversations there in the chat room now. And until we meet again, be safe and keep well.
So to those of you who are still here, just a reminder that you can click on one of the breakaway room links in the chat. So I'll post them again there, but you've got links to the local fixed income room, the SA multi-asset high equity room, global equity, and ESG. Please click on one of those links and Zoom should teleport you into that particular room. Those will be open until 5 to 2 South African time, so another about 25 minutes or so. Otherwise, you can stick around in the main room and listen to more from Johnny Clegg. And also just a reminder about the Excel Masterclass, which is free, your complimentary gift as an attendee of the BCI conference. That's happening next Tuesday. And that's going to be really, really exciting. So we hope to see you there. I've posted the link to register in the chat as well. So looking forward to seeing you next Tuesday morning for that Excel Masterclass.
Thanks again, Dan. You do brilliant work.
Thanks, Eugene.